new technologies are you seeing being introduced into the shipping industry?
So we have seen pilot technologies being developed for years now, but what's interesting about this current moment is that we're seeing big players invest in these technologies that are not yet economically viable, but that one day might be. So for example, we are seeing earlier this year, the world's largest agricultural commodities trader, Cargill, saying they will invest in attaching sails to their ships so they can make any technology that they run their ships on more efficient. Similarly, we have seen a spin-off of Airbus, the aeronautics company, developing a similar application with kites. We have been following also developments in hydrogen. So at the moment, hydrogen fuel seems like a good option, a possible option when it has been developed and when it becomes economically viable. And we have Vestas, for example, the world's largest turbine maker, developing some ships that will be able to run on hydrogen in the near future.
Coming up, rising sea levels means humans need to get creative when it comes to coastal defenses. But how do we protect both ourselves and the environment? One Israeli startup may have the answer. That's coming up next. This is Bloomberg Green. In London, I'm Anne-Marie Hordern. This is Bloomberg Green. After water, what's the resource that humans use the most? It's concrete, 3 tons a year for every person on the planet. And engineers estimate it's used twice as much as all other building materials combined. And it comes with a huge environmental cost. Concrete, not just in cities, it's a common feature on our coastlines too. And that's taking a toll on biodiversity. But one Israeli startup has found a way of making sea defenses stronger and encouraging life to thrive.
If you take a look at concrete structures like breakwaters or seawalls, the water around them is often clear. That's not actually a good thing, because it means there's no life. Marine species are actually most abundant in coastal areas, but it's also where us humans prefer to live too. So when we build here, we drive away marine life.
Concrete in the marine world has a lot of additives, a lot of chemicals, and some of those materials are actually leaching out, and they're actually prohibiting marine life to thrive. If we keep developing without any regards to natural communities, there is a tilting point from which beyond we cannot really go back.
In the coastal city of Tel Aviv, an Israeli startup wants to revolutionize our urban coastlines. Their sea defenses are transforming lifeless man-made structures into teeming ecosystems. They do this by replacing standard concrete with their own special cement formulas.
As opposed to regular cement-based concrete, e-concrete includes certain elements that enhance the growth of marine flora and fauna of plants and animals. Our admix, which is kind of our secret sauce, is basically kind of sealing the concrete, making it less aggressive for the marine environment. That once we add it, we enable life to flourish.
In the lab, the team run tests to identify what mixes will work best for marine life.
So we take really ice cube sized concrete slabs of different compositions. And we put larvae, 20, 30, 50. We need to have a lot of replicates. We're geeky scientists, so we have to have a lot of replication and controls. And then within a few days or just a few weeks, we can get an answer on their preference. So obviously, if they die, they have a very low tolerance to that specific concrete mix design. And if they thrive or they flourish, we can quantify that very quickly.
E-Concrete says it typically sees double the biodiversity of regular grey concrete. From fish and sea caterpillars on their armour blocks to crabs on these tidal pools that sit on the shoreline.
This unit holds water during the low tide, so it's always moist, and therefore it has a very comfortable habitat for crabs and sea anemones and sea stars, etc. These pools have been here for less than 3 months, and this is already what you can see. It's covered with life. See the rock around it, which has been here for probably 10, 20, maybe even more years, only has a thin layer of green algae, and that's it.
As well as the composition of the cement mix, E-Concrete designs its products specifically to the marine environment it will be deployed, to create niches for endangered species, or to develop nurseries like these oyster beds. The final part of the equation is creating complex surface textures to mimic natural rock or coral, an environment that helps anchor young organisms.
When concrete elements are being cast, the typical goal is to have a very slick surface, very, very smooth. The idea is to get the water to flow right across it. When we're designing E-Concrete with a rough surface, we want to do the complete opposite. We want to slow the water when they are crossing the structure so that the larvae can actually adhere and attach to the surface.
E-Concrete has to offer its clients more than just ecological credentials. Over time, they've discovered that creating hospitable habitats for marine life adds another advantage, one that is surely hard to ignore.
We've seen evidence to the fact that the growth of the organisms on the concrete create kind of a layer of defense. Just the addition of weight, we can actually gain stability and strength over time.
This is let's say the unit when we put it in the water. And this is after a year in the water. And what you can see here is all the oysters are completely covering it. We designed the units so they can withstand the forces and perform in terms of structural performance, but they can also be a backbone for ecological enhancement.
The company tests its miniature designs in tanks full of real seawater, rocks, plants, and animal life from around the world.
What we're looking for is the accumulation of calcium carbonate on the surface of the concrete of different mixes and different designs. This is the process that we call biogenic buildup. So with time, we get a buildup of calcium carbonate that is sourced from marine organisms on the surface of the concrete. And we actually encapsulate the concrete with a natural rock. So when the organism die, in the case of a coral, it will die, and then another coral will sit on it, and that's how a reef is growing.
The hope that our man-made structures could become stronger over time also means better economics. The units require less maintenance and could therefore stay in the water for longer. E-Concrete, though, is just a few years old, so it needs more time to really quantify the longevity of its products. But the company are certain their products are better for the environment, and not just in terms of improving biodiversity.
We're kind of trying to offset some of that immense carbon footprint of the concrete industry.
Construction is responsible for about 11% of global carbon emissions. By adding a biological crust to their products, E-Concrete prevents some CO2 from being released into the atmosphere.
For every kilogram of calcium carbonate being created by those marine organisms, we're offsetting 120 grams of CO2. So think about building a port infrastructure or a city waterfront that is an active carbon sink. I think that's a great advantage of the technology.
That does it for this week, but let's keep the conversation going on Twitter. Follow us at Climate. I'm Anne-Marie Hordern, and this is Bloomberg Green.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser on Bloomberg Radio.
Live from our homes in New York and New Jersey, streaming on YouTube. It is a Fed Wednesday, December 16, 2020, and those Fed headlines crossing the Bloomberg. I'm Carol Masser along with Tim Stenovic of Bloomberg Quick Take. Quick headlines here. Fed to continue bond buys until, quote, substantial progress on goals. The Fed extending its temporary dollar swap lines and repurchase facility. So that is some of the quick headlines. We're going to break down, though, this last Fed decision, Tim, of the year. It's going to be Jay Powell. It's going to be a press conference at the bottom of the hour. And so we'll see what he has to say to wrap up what has been a remarkable year on so many different levels.
Yeah, historic year for Federal Reserve Chair Jerome Powell. One, I think that will be remembered as really stepping in, I think it's fair to say, really saving the financial markets early on in the year. The big question is, how much will he have to do, continuing, and what it looks like next year?
Right, especially as we wait more stimulus, and fingers are crossed on that. All right, let's get a check on that trading day, some market reaction. Seeing a little bit of movement here, Charlie Pella. Look at the equity trade.
Just a little bit. Let's get right to the numbers. We'll give you more on the why in a moment here. The S&P up now by 1 point. Little change, but truth be told, into the decision, S&P was trading little change. The Dow lower now by 85 points, down 0.3%. The NASDAQ Composite Index holding on to gains today, on track for another record close, up 32 right now, a gain there of 0.3%. Your 10-year down 7/30 seconds. The 10-year yield on this Fed Wednesday, 0.93%. Gold, a little change right now, virtually flat on the day at $18.53 the ounce. And West Texas Intermediate crude right now, WTI is up 0.3%, 47.79 a barrel. This headline from the Bloomberg: Google being sued by Texas over abuse of dominance in an antitrust case. Again, recapping equities trading mixed, S&P now flat. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. And as Charlie mentioned, a little bit of a reaction on the equity side of things, but we also want to dig into what we're seeing in terms of the Treasury market reaction. If I take a quick look at the 10 with the yield of 0.93, that 5-year note with the yield of 0.37, and that 2-year note, the shorter end of the yield curve, 0.11. So let's get into it and get some market reaction. You are listening to Bloomberg Business Week, and a focus on the Fed on this Fed Wednesday is brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit commonwealth.com to learn more. It is Fed Wednesday. We are Bloomberg Business Week. Carol Masser along with Tim Stenovic. Let's bring in the team. Kathleen Hayes, Global Economics and Policy Editor at Bloomberg News. She's back in our Interactive Brokers studio. Dave Wilson, Stocks Editor at Bloomberg News, on the remote access from New Jersey. Kathleen, you had a few minutes to look at these headlines. What stands out for you?
Well, I'd just like to start with what the bond market has done, Carol, because I made very careful note of where it was. And it was flat. Just maybe the 10-year was down a tenth. The 10-year is now down 11/30 seconds. The 30-year bond, which was down 3/30 seconds, now down a full point. Why, Kathleen, do you ask? Well, because the Fed, as mostly expected, apparently at least in the policy statement, has said nothing about the possibility of, number one, increasing the number of bonds they've been buying. That wasn't so expected, but at the very least, some signal that they are ready to start changing the composition of the bond maturities, right? Go out the curve, buy more long-term bonds, make sure that 10-year, which the yield is currently 0.94, people are going, oh my God, what if it goes above 1%? Well, the Fed apparently is not ready to say that yet. Certainly at the press conference, Jay Powell will be asked about that. I think what surprised me, I guess not, when the Fed, one of the headlines here is Fed activity saying that economic activity and employment have continued to recover, okay? So some people are really concerned about even a negative first quarter, for example. Something that didn't change, median forecast showing rates near zero through 2023. So the dot plots will not have changed. And of course, they're revising their economic and inflation forecasts, et cetera, et cetera. But the headlines, one more thing we throw in, that they're extending the temporary dollar swap lines and repurchase facility, because that's just showing the doors open to overseas central banks reaching out if they need a little help from the Fed.
And forgive me if you said this, I'm been listening to you going through the Bloomberg. The Fed forecasting shows 5 of 17 officials saw a rate hike during 2023, so looking way out. Tim, we got to talk about the equity market reaction too.
Yeah, we certainly do. I mean, is anything surprising equity investors right now?
Dave, you want to come in on that?
Yeah, it sure doesn't look like it because you had a little bit of fluctuation in the S&P 500 after the meeting results were released. But I mean, you're talking about an S&P 500 that's up 0.1% at this point. And if you look at things as they shake out in terms of industry groups, it's a familiar kind of story. You know, the top performer among the 11 main groups, consumer discretionary, it's a category that includes retailing and therefore includes Amazon.com. And the entire gain in that index can be explained by the fact that Amazon is up 1.8%. And then right after that, technology stocks. And certainly they've been a story, you know, for some time. But 7 of the 11 groups are lower. Utilities taking the biggest hit. Talk about an interest rate sensitive group. So, you know, what we're seeing, not really a whole lot in what the Federal Reserve released to change investors' minds, it seems, when it comes to stocks here.
So it's fair to say, Dave, that there were no big surprises, at least when it came to investors, in this latest Fed meeting.
Sure doesn't look that way. I mean, not a whole lot of fluctuation in share prices, that's for sure.
Yeah, it's interesting, too, and I'm just going through our Bloomberg Live blog. Love this. Notably, officials did not change their tone with respect to economic conditions, reiterating that the recovery will depend on the course of the virus and that the pandemic will continue to weigh on conditions in the near term. They say it poses considerable risks to the outlook in the medium term. You know, we're watching this. Kathleen, you know, it's so interesting. I just think about Fed decisions of the past where we were also focused on the rates for often, you know, but it's not really about that. It's really about what they are doing to either help out this economy because of the pandemic.
Well, and I think you're right to point out the fact that, yes, it's still going to, they're still saying that the economy is going to depend on the virus, and we could even add to that, well, vaccines, how quickly can you get them out,
right,
et cetera. I think it's interesting, too, when you look at the change in the summary of economic projections, the SEPs, which that's where the dot plots for the interest rate hikes come from. People were saying, including Yelena Shaletyeva and our Bloomberg Economics team before this came out, that undoubtedly their outlook for unemployment, because it's come down a lot faster than they expected, would be much brighter. And in fact, they do say the 2020 jobless rate, 6.7. They had forecasted 7.6. And for next year, you look at down to 5.0 versus 5.5. You know, those are unemployment rates that look like the olden days, right? Before we got to those 50-year lows. The GDP forecast a little bit more optimistic. On inflation, though, they really have a little bit of improvement, but not much. They don't see us getting the economy getting to 2% on the core inflation rate until 2023. But I think that's kind of what they've been saying for a while.
Kathleen, I do want to ask you, we were talking about it early on our planning call, that if during the Powell press conference, if news comes down about a stimulus plan or any progress, significant progress, would we assume that everybody in the room will have access to headlines and that is something that they could bring up?
You know, that's a very good question, Carol, because I remember thinking now, you're absolutely right. The times I've been there, you have to, well, certainly in the lockup, because you go in early, then you give over your cell phone. However, you are allowed to have laptops because that's how you put the headlines together to flash them. So yes, I think during the presser they will. I thought you were going to ask me how Jay Powell reacted, and I was going to say he'll probably do a happy dance right there in the middle of the press conference.
Okay, I mean, that would make my year of 2020 if Fed Powell did a happy dance. I'm just going to put that out there.
Yeah, well, you know, he does play guitar, and he and his wife love to dance. You read this all the time. He's quite a Renaissance man, but it's certainly a big deal. It's probably the biggest deal for the Fed, and I expect that, you know, reporters are going to ask him a number of different questions about this, like what if this doesn't pass? Do you get worried, Chair Powell, about a negative first quarter, et cetera? So I think this is something that is clearly on the table. We'll hear more about it, but any minute, you know, we were talking about that well into the night on U.S. Asia, you know, our Daybreak Asia and Bloomberg Market shows the stimulus package. Everybody's watching.
Yeah, absolutely. Dave Wilson, what are you going to be watching for during that Powell press conference? Since it doesn't look like we're having, although I will say the equity markets look like they're steepening some of their losses, but mind you, not a ton. And the NASDAQ has pared its gain. It was up about 45 prior to the Fed announcement, now just up about 18, 19 points. What could Fed Chief Jay Powell say that could maybe move the equity markets here?
Well, I think the real question is how much pressure does he put, in essence, on Congress and the White House to try and get something done in terms of a stimulus? You know, how does he see things shaking out based on whether they come together, get something done, or let's wait until next year. I mean, that's going to be well worth listening for.
All right, that is certainly setting us up really well. Hey, guys, thank you so much. Dave Wilson, stocks editor at Bloomberg News on the remote access from New Jersey. Kathleen Hayes, global economics and policy editor at Bloomberg News. She's back in our Interactive Brokers studio. All right, you are listening to Bloomberg Business Week, just crossing the Bloomberg. California reporting 53,711 new virus cases, shattering a record. So really, right, Tim? I mean, it's just, you have family out there.
Yeah, and we learned also, too, that the governor has ordered thousands of body bags because of the concern around the coronavirus. California administering its first vaccines this week, like many parts of the country as well. But like we say every day, Carol, it cannot come soon enough.
No, I agree. All right, let's get a check on world and national news headlines. Of course, those virus headlines troubling. Nancy Lyons in our D.C. studio. Hi, Nancy.
Hey, Carol. Congressional leaders are rushing to finish a government spending package that will also include another round of pandemic relief. According to people familiar with the negotiations, the current plan would include stimulus payments to individuals and supplemental unemployment insurance, but it would not offer liability protections or direct aid to state and local governments. Well, officials today provided an update on Operation Warp Speed and say they are preparing to roll out 2 million more doses of the Pfizer vaccine next week. Health and Human Services Secretary Alex Azar says they're also hopeful the FDA will authorize the Moderna vaccine in the coming days, which would mean another 5.9 doses of vaccines to distribute. But he says these vaccines only work if people use them.
We still have much work to do to ensure that all Americans understand the value of these safe and effective vaccines, but it's clear that many Americans are learning that these vaccines are safe and extraordinarily effective.
The chairman of the Senate Homeland Security Committee is defending his decision to hold a hearing today on alleged voting irregularities in the election. Wisconsin Republican Ron Johnson says all allegations must be investigated.
Even though courts have handed down decisions and the Electoral College has awarded Joe Biden 306 electoral votes, a large percentage of the American public does not believe the November election results are legitimate.
Attorneys for President Trump have not prevailed in dozens of legal challenges in battleground states. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg. Now let's get a business flash from Charlie Pellett.
Hi, thank you very much. And here's what's going on. Federal Reserve to maintain bond buys until, quote, substantial economic gains are seen. The 10-year, the yield there, 0.93%, down 8/30 seconds. Little change for U.S. equity markets, but the S&P is now trading lower, down by just about 0.1%. Ahead of the decision, have been up by about 0.1%. But bottom line here, little change in the S&P at 3692. We have got the Dow down 102 points now. That is a drop of 0.3%. NASDAQ holding on to gains, up 15 points, higher by 0.1%. Any close higher today for the NASDAQ Composite Index will be another record. Stocks trading mix. Treasuries fell after the Federal Reserve pledged to keep its bond buying program until the economic recovery experiences substantial progress. Gold is down 0.2%, $18.50 the ounce, and West Texas Intermediate crude up 0.3% right now, $47.72 a barrel. Recapping, S&P little change, down a point. I'm Charlie Pellett. That is a Bloomberg Business Flash.
It is indeed. All right, Charlie, really appreciate that. You are listening to Bloomberg Business Week. Carol Massar along with Tim Stenovic of Bloomberg Quick Take. And our top headline, certainly at this hour, top story, Tim, the Fed saying it will continue to support the economy through massive monetary stimulus until it sees, quote, substantial further progress in employment and inflation. So they're watching this, and I'm assuming they're going to get a lot of questions. Jay Powell will indeed on all of this. Let's do some analysis and let's talk about this, because keep in mind, in just about 17 minutes time at the bottom of the hour, we will hear from Jay Powell, chairman of the Federal Reserve, his comments, and of course, that press conference with reporters after today's decision. So let's bring in Frances Donald. She is Global Chief Economist, Head of Macroeconomic Strategy at Manulife Investment Management. She's on the phone in Toronto. Stephen Skanke back with us, also Chief Economic Advisor at Killpoint, former U.S. Treasury and White House National Security Council staff member. He's based in Washington, D.C., and I believe that's where he is on the phone on this Fed Wednesday. Steve, let me start with you. So Fed maintaining its bond buys, just watching, looking for the economy to see some improvement. What's key for you in terms of this decision?
Well, it's not surprising that the Fed didn't change any of its policy stance. There was a little bit of expectation that they might say something about the composition of their bond buying. But on net, there was nothing for them to gain by doing that. So they just held it steady. Obviously, the economic environment is particularly complicated with the vaccine rolling out, but yet at the same time, record rates of infection, hospitalizations, mortality. I think what was most interesting to me, though, was the adjustment in their economic projections. Even with all the swirl that's going on in this quarter and weak economic news on retail sales coming even just today, they did reduce or they did improve the projection for change in real GDP for 2020 overall, taking it from minus 3.7% for the year to minus 2.4%. That's actually quite encouraging. And likewise, for 2021 and 2022, they also improved their projected estimates.
Well, it's interesting. And Neil Dutta of Renaissance Macro emailing me and saying, the bond market gets, because he said, too, the Fed marking up growth in each of the next 2 years, marked down unemployment and marked up core inflation. The bond market's selling off because it gets that positive growth story. Francis, come on in on this. Is that also what is jumping out at you or is something else?
Here's what's jumping out at me. We got the end of the news on fiscal. We're getting a fiscal package that looks like it's done today. We get a Fed that basically does nothing and marks up growth and inflation. And all we got was a 3.5 basis point jump in the 10-year to 94 basis points. Yes, the bond market knows things are a little bit better now than they were before, but the bond market is also staring down 3 months of data that is going to quickly deteriorate. A central bank that is, whether they do it now or next month, going to have to extend weighted average maturity, and the possibility that there are, ongoing turbulence created by the disappearance of 13.3 programs. When I look at this bond market, we can kind of look at the daily charts, but it's telling you the same thing, which is that we're still stuck in a recessionary environment. And even if you throw a massive fiscal package and a more hawkish than expected Fed statement, you're still only getting the 94 basis points. And that's the biggest message I can read in the last 15 minutes.
Well, Francis, what more could the Fed do here? I mean, we're looking at the forecast. It shows that 5 of 17 officials see a rate hike happening during 2023. The median forecast showing that rates are going to be at near zero levels through 2023. What more can the Fed do to stimulate the economy?
The Fed can't do much to stimulate the economy at all, but they can reduce the possibility of tail risks. They can make sure that we don't incur a rate tantrum right at a period when the economy goes through a double dip. And in fact, they should be doing this. Now, Powell's going to get away with this, just like Lagarde did last week. Just a little bit of an increase in yields, that's totally something that the entire economy and financial system can deal with. But if we start to see rates move above that 1% and we get more nervous, more of that reflation trade coming in, then we might be heading into a period where those tail risks start to become higher probability. We don't rely on the Fed to boost employment. You can lower rates as much as you want. I'm not going to a movie theater. But what you can do is make sure that it doesn't create a spiraling event that creates a credit event. I think Powell's going to have to come in here in about 12 minutes and lean pretty heavily here, or else he's going to have to direct the New York Fed to start buying farther out the curve as they have been in the last week or so.
Well, Francis, you took us exactly where I want to go. Steve, come on in back on this conversation. I mean, what do you want to hear from Powell? What would you be asking him? And I do think about, do we need to really start thinking about, this is the last Fed meeting of this year. The first one of next year will be just after the Biden administration gets into the White House. We've already talked about a lot of collaboration expected between Powell and Yellen and the economic team of Joe Biden. But what is it that you would want to ask Powell, and what are you expecting come January?
Well, what I'd really like to ask him, but I'm sure he won't answer at all, is how does he look forward to the partnership with the new Treasury Secretary, his old friend Janet Yellen, and what types of things are they thinking about? They're going to have some big challenges coming ahead. The disadvantaged labor groups, some specific industries that are facing insolvency and credit issues that liquidity won't really solve, and What do they do when they can't get the sort of fiscal stimulus that they really need to have, and how is all that going to work together? I think it's premature for him to tip his hand on that, but we'll see if any of the questioning can tease any of that out. That's the big challenge. To do much right now is no gain for the Fed. Better to be reserved, keep quiet, see how things behave. And if they need to do something before the end of January, obviously they can do that. But for right now, just lay low and act confident and give markets a positive signal.
Francis, let's kick that same question over to you. What would you ask the Fed chair if you were able to talk to him in a few minutes?
Well, if it was over drinks, I'd ask him if he saw this morning's retail sales report.
I want to be at that. I want to be at that drinks, by the way.
Yes, it's definitely
nice.
It's definitely over drinks.
Yeah, if I was in the room though at 2:30, I'd probably dive deeper into what they're expecting to do with the longer maturities and how comfortable they are with them. And the reason that I want to ask that is because I would want to subtly get under the surface of how much of a connection Powell wants between fundamentals and rates. Is he ready to take off the reins and let the market trade off of better news, push that 10-year higher up until where it should be, which is probably closer to 140, or do they want to maintain some financial repression in this and allow some overheating? Of course, he'll never say that he's happy with financial repression in the bond market, but if you could get a sense of where they're going on longer duration purchases, that might give you a little bit of some insight into the way they're thinking about that.
Well, Francis, and do you think he's also thinking about something we've talked about a lot on air with Peter Atwater about the K-shaped recovery? There are people who don't really even feel this economically, or they're in the markets and they've made a lot of money and they've actually done okay. And then there are others who have felt so much too much. And I do wonder if Jay Powell, I think he is thinking about letting it run a little hot so that those who really have been left out here again maybe get some help.
Yeah, Carol, I think they probably obsess over the K-shaped recovery, both because it impacts manufacturing and services differently, so the stock market's going to take off while the rest of the economy gets left behind, but also because if we look at what central banks are doing, they continue to expand the way they're looking at the world. They're talking about climate change, income inequality, racial inequalities. The Reserve Bank of New Zealand talking about housing affordability. Now, that doesn't mean that they're going to change their dual their inflation and employment mandate, but it does mean the scope over which they observe that is going to change. And this is why, yes, we can kind of talk about the 3 basis points in the 10-year. We can talk about weighted average maturity, but look at the dot plot. Look at what they're telling us in average inflation targeting. The Fed is not lifting off till at least 2024, 2025, and the rest of it is really kind of coming down to tactical trading and not the main messaging that they're trying to get across. And I really hope that at 2:30, Powell just pounds that down to the table and reminds us we are not thinking about raising interest rates because we use a word like that today.
Steve, I want to bring you back in here and then just talk more about these interest rates, potentially staying at near zero rates until 2023. What are the long-term implications of that? I mean, beyond financial markets, we look what's happening in the real estate industry because mortgage rates are just at rock bottom right now, and demand is pushing prices higher throughout the country despite this weak economy. Give us an idea of long-term implications of low interest rates.
Well, over time, you can get disruption in fixed income and borrowing markets when rates stay too low for too long. But it seems like they're willing to take that chance and run that experiment. Both Janet Yellen and Jay Powell have spoken often about the need and the fact that lower income groups and disadvantaged labor groups only benefit at in the final stages of the economic growth cycle, and so they are going to let the economy run a little bit hot and inflation be a little bit on the high side to get out there. And whether that means that they have to apply the brake pedal all that much more firmly if inflation should accelerate, that might be the case. It's not helpful to long-term equilibrium in free markets, but I don't think that's their focus right now.
You know,
their real focus is the K-shaped recovery and doing something to benefit those that are on the bottom leg of that K.
Mohamed El-Arian tweeting out over PIMCO, and he's saying he highlighted a certain segment of Chair Powell's upcoming press conference, and or from the Fed statement, I should say, and he says that this should be talked about at the press conference. But he said, in addition, the Fed. This is the statement from the Fed. In addition, the Fed will continue to increase its holdings of Treasury securities by at least $80 billion per month, and of agency mortgage-backed securities by at least $40 billion per month, until substantial further progress has been made toward the committee's maximum employment and price stability goals. I mean, so he's saying, you know, he'll be asked a lot more about that. And I guess some more details about that. I mean, I don't know, Francis, we talked about this before. I mean, there isn't a lot more that the Fed can do, especially when it comes to, you know, they're about lending. They're not about spending. That's where Congress comes in. And I do wonder what he will say, or what we need him to say at the press conference when it comes to that next round of federal aid and federal stimulus. That seems to be making progress, but man, it's taking forever.
Yeah, you know, I think I'll push back against the idea that the Fed can't do anything else. They can flatten this curve pretty aggressively, and they can make sure that the so-called inflation scare that's coming through doesn't materially lift rates prematurely, particularly in a period where we're heading into weakness. But I think one of the things central banks are going to have to push back on in the next year or so is really, trying to push back against the idea that they're even thinking about normalizing. The ECB just suddenly brings up the concept of a roll-off. Nobody was asking them about that. They just volunteered that information. It's like those memes that go like, nobody, absolutely nobody. Hey, you want to hear about our roll-off plans? These are not really what we need to be hearing. What we need to be hearing is we're boring. We're not doing anything. We'll do more if needed. We're not even thinking about what an exit plan looks like. We need that. We just need that for 3-6 more months. That's all I need. Just 3-6 more months. Then we can talk about roll-offs.
Right.
But going into a period that's very, very weak, and we have to prepare for it. We have to be proactive, not reactive.
Well, it's a year where we talked, so much about deliberate actions, whether it, of all that ails us, right? It needs to be, and it sounds like, Francis, that's what you're saying. Steve, do you agree that the Fed needs to be incredibly deliberate right here about, and make sure its message is very clear?
Oh, absolutely, because the markets can become confused, especially as Francis says, when you look at what the ECB just sort of let drop out there. The Fed has been adamant about that, and I think that the Chairman Powell will reiterate that, just so there's absolutely no confusion that they're thinking about doing anything in terms of raising rates or dampening down their quantitative easing until well into 2023 or beyond even the end of 2023, depending on where labor markets and inflation are at that point in time. I don't think we'll hear about it today because these are primarily the biggest issues.
Yeah.
But there's also an opportunity if in the new Congress, and depending on what that composition looks like, if there's not an opportunity to obtain the sort of fiscal stimulus that the incoming Biden administration thinks that it needs, of the Yellen-Powell combination, figuring out how the Fed can provide fiscal-like monetary stimulus in 2021 to get that additional boost that they may decide they need to have.
Steve, we talk a lot about the Fed chair, of course, being very deliberate with his language and deliberate in those statements, but what could he say today that could move markets?
Well,
Steve?
I think if he waffles at all on the interest rate outlook.
So it's more of a question of what he doesn't say.
Yeah, it's more a question of what he doesn't say. The statement that they came out with was very clear. There had been a lot of hope and expectation that they would say something about extending duration, increasing Treasury bond buying at the expense of mortgage-backed security bond buying, and they avoided all of that. I think because it's not needed, it's untimely, it clouds the issue, and it gives the markets a better opportunity to misread what they're trying to say. So they're in a very narrow lane in what they put in their press release.
Right.
My guess is that Chairman Powell will stay in that lane and be deliberate about reiterating the points that they made in the press conference.
Got it. Francis, saving you 30 seconds. Final thoughts here.
Powell's got to lean back against some of this hawkishness after this statement. I'm very nervous about this press conference. It'll come down to communication. I wouldn't be surprised. You could make an argument that we see rates test 1% at the end of this press conference, or they're back down 5 basis points. It's been a long time since we've headed into a press conference where I've been so nervous and the range of outcomes so wide.
Yeah, exactly. All right, going to leave it there. Thank you both. Frances Donald, she's Global Chief Economist, Head of Macroeconomic Strategy at Manulife Investment Management, on the phone from Toronto. And, of course, Steve Skanke, Chief Economic Advisor at Keel Point, former U.S. Treasury and White House National Security Council staff member. We do want to take you to D.C. We are anticipating the press conference beginning with Fed Chief Jay Powell. Let's take you there.
Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Since the beginning of the pandemic, we've taken forceful actions to provide relief and stability, to ensure that the recovery will be as strong as possible, and to limit lasting damage to the economy. Today, my colleagues on the FOMC and I reaffirmed our strong forward guidance for interest rates and also provided additional guidance for our asset purchases. Together, these measures will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete. Economic activity has continued to recover from its depressed second quarter level. The substantial reopening of the economy led to a rapid rebound in activity, and real GDP rose at an annual rate of 33% in the third quarter. In recent months, however, the pace of improvement has moderated. Household spending on goods, especially durable goods, has been strong and has moved above its pre-pandemic level. In contrast, spending on services remains low, especially in sectors that typically require people to gather closely, including travel and hospitality. The overall rebound in household spending owes in part to federal stimulus payments and expanded unemployment benefits, which provided essential support to many families and individuals. The housing sector has fully recovered from the downturn, supported in part by low mortgage interest rates. Business investment has also picked up. The recovery has progressed more quickly than generally expected, and forecasts from FOMC participants for economic growth this year have been revised up since our September summary of economic projections. Even so, overall economic activity remains well below its level before the pandemic, and the path ahead remains highly uncertain. In the labor market, more than half of the 22 million jobs that were lost in March and April have been regained, as many people were able to return to work. As with overall economic activity, the pace of improvement in the labor market has moderated. Job growth slowed to 245,000 in November, and while the unemployment rate has continued to decline, it remains elevated at 6.7%. Participation in the labor market remains notably below pre-pandemic levels. Although there has been much progress in the labor market since the spring, we will not lose sight of the millions of Americans who remain out of work. Looking ahead, FOMC participants project the unemployment rate to continue to decline. The median projection is 5% at the end of next year and moves below 4% by 2023. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been the hardest hit. In particular, the high level of joblessness has been especially severe for lower-wage workers in the service sector and for African Americans and Hispanics. The economic dislocation has upended many lives and created great uncertainty about the future. The pandemic has also left a significant imprint on inflation. Following large declines in the spring, consumer prices picked up over the summer, but have leveled out more recently. For those sectors that have been most adversely affected by the pandemic, prices remain particularly soft. Overall, on a 12-month basis, inflation remains below our 2% longer-run objective. The median inflation projection from FOMC participants rises from 1.2% this year to 1.8% next year and reaches 2% in 2023. As we have emphasized throughout the pandemic, the outlook for the economy is extraordinarily uncertain, and will depend in large part on the course of the virus. Recent news on vaccines has been very positive. However, significant challenges and uncertainties remain with regard to the timing, production, and distribution of vaccines, as well as their efficacy across different groups. It remains difficult to assess the timing and scope of the economic implications of these developments. The ongoing surge in new COVID-19 cases, both here in the United States and abroad, is particularly concerning, and the next few months are likely to be very challenging. All of us have a role to play in our nation's response to the pandemic. Following the advice of public health professionals to keep appropriate social distances and to wear masks in public will help get the economy back to full strength. A full economic recovery is unlikely until people are confident that it is safe to re-engage in a broad range of activities. As we previously announced, we are now releasing the entire package of our SEP materials at the same time as our FOMC statement. Included in these materials are 2 new exhibits that show how the balance of participants' assessments of uncertainty and risks have evolved over time. Since the onset of the pandemic, nearly all participants continue to judge the level of uncertainty about the economic outlook as elevated. In terms of risks to the outlook, fewer participants see the balance of risks as weighted to the downside than in September. While a little more than half of participants now judge risks to be broadly balanced for economic activity, a similar number continue to see risks weighted to the downside for inflation. The Fed's response to this crisis has been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. As noted in our statement on longer-run goals and monetary policy strategy, we view maximum employment as a broad-based and inclusive goal. Our ability to achieve maximum employment in the years ahead depends importantly on having longer-term inflation expectations well anchored at 2%. As we reiterated in today's statement, with inflation running persistently below 2%, we will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until the current 0 to 1/4% target range for the federal funds rate, until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. In addition, as we noted in today's policy statement, we will continue to increase our holdings of Treasury securities by at least $80 billion per month and of agency mortgage-backed securities by at least $40 billion per month until substantial further progress has been made toward our maximum employment and price stability goals. We believe the increase in our balance sheet this year has materially eased financial conditions and is providing substantial support to the economy. Combined with our forward guidance for the federal funds rate, our enhanced balance sheet guidance will ensure that the stance of monetary policy remains highly accommodative as the recovery progresses. Our guidance is outcome-based and is tied to progress toward reaching our employment and inflation goals. Thus, if progress toward our goals were to slow, the guidance would convey our intention to increase policy accommodation through a lower expected path of the federal funds rate and a higher expected path of the balance sheet. Overall, our interest rate and balance sheet tools are providing powerful support to the economy and will continue to do so. The Federal Reserve has also been taking broad and forceful actions to more directly support the flow of credit in the economy for households, for businesses large and small, and for state and local governments. Preserving the flow of credit is essential for mitigating damage to the economy and promoting a robust recovery. Many of our programs rely on emergency lending powers that require the support of the Treasury Department and are available only in very unusual circumstances, such as those we find ourselves in today. These programs serve as a backstop to key credit markets and have helped to restore the flow of credit from private lenders through normal channels. We have deployed these lending powers to an unprecedented extent, enabled in large part by financial backing and support from Congress and the Treasury. Although funds from the CARES Act will not be available to support new loans or new purchases of assets after December 31, the Treasury could authorize support for emerging lending facilities if needed through the Exchange Stabilization Fund. When the time comes, after the crisis has passed, we will put these emergency tools back in the box. As I have emphasized before, these are lending powers, not spending powers, The Fed cannot grant money to particular beneficiaries. We can only create programs or facilities with broad-based eligibility to make loans to solvent entities with the expectation that the loans will be repaid. Many borrowers are benefiting from these programs, as is the overall economy. But for many others, getting a loan that may be difficult to repay may not be the answer. In these cases, direct fiscal support may be needed. Elected officials have the power to tax and spend and to make decisions about where we as a society should direct our collective resources. The fiscal policy actions that have been taken thus far have made a critical difference to families, businesses, and communities across the country. Even so, the current economic downturn is the most severe of our lifetimes. It will take a while to get back to the levels of economic activity and employment that prevailed at the beginning of this year. And it may take continued support from both monetary and fiscal policy to achieve that. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We are committed to using our full range of tools to support the economy and to help assure that the recovery from this difficult period will be as robust as possible. Thank you. I'll look forward to your questions.
Thank you. Rich Miller.
Thank you very much, Mr. Chairman. Thank you, Michelle. I wonder if I could start with the SEP. We have unemployment now is at 6.7. The SEP median sees it falling to 5. Headline inflation is 1.2. The SEP median sees it rising to 1.8, and core inflation is 1.4, and the SEP sees it rising to 1.8 likewise. Would that constitute substantial further progress toward the committee's maximum employment and price stability goals?
Yes, well, so we're not going to be identifying specific, associating that test with specific numbers at this point. So really the question is, what do we mean by that language? And really the overarching message, Rich, is that our guidance for both interest rates and asset purchases will keep monetary policy accommodative until our maximum employment and price stability goals are achieved, and that's a powerful message. So substantial further progress means what it says. It means we'll be looking for employment to be substantially closer to assessments of its maximum level and inflation to be substantially closer to our 2% longer run goal before we start making adjustments to our purchases. I would also point out that by increasing our asset holdings, we see ourselves as adding policy accommodation. There will come a time when the economy does not require increasing amounts of policy accommodation, and when that time comes, and that will be uncertain, and in any case is some ways off. So I can't give you an exact set of numbers. We will, of course, as we approach that point, we'll be evaluating that, and when we see ourselves on a path to achieve that goal, then we will say so undoubtedly well in advance of any time when we would actually consider gradually tapering the pace of purchases.
Very quickly on that, you mentioned the next couple of months are going to be very challenging, and regarding asset purchases, why not increase the duration of the asset purchases at this time, given what you see as a very challenging period ahead?
So, you know, again, I would start with what we actually did at the meeting, which was we provided this guidance about the path of asset purchases, and I just went through what the guidance that we put forward, and you know, so I guess since September we've now adopted a flexible average inflation targeting framework. We have provided rate guidance that is tightly linked to the goals as expressed in that new framework, and now we've done the same for asset purchases. So, you know, we've been sort of, as the future has become clearer, and as we've absorbed new developments in the medical sphere and also in the economy, we have began to be able to see further. So we've started to be able to provide further important guidance, and we think that the asset purchase guidance is very important. We think that the prior language of in coming months was obviously temporary. This links that guidance, those purchases, to actual substantial further progress toward our mandated goals. We think that's important. And we think that is important to have done. I would just add, though, that we also continue to think that our current policy stance is appropriate. We think it's providing a great deal of support for the economy. Financial conditions are highly accommodative, and we monitor a range of financial condition indexes. There are many of them, and they'll all pretty much tell you that. You can also look at the interest-sensitive parts of the economy, for example, housing, durable sales, vehicle sales. Those parts of the economy are performing very, very well. The parts of the economy that are weak are the service sector businesses that involve close contact. Those are not being held back by financial conditions, but rather by the spread of the virus. And I'll close by just saying we do have the flexibility to provide more accommodation through the channel you mentioned and through other channels. And we recognize that circumstances could shift in a way that warrants our doing that, including by adjusting purchases. We are committed to using our full range of tools to support the U.S. economy to achieve our goals. We will continue to use our tools to support the economy for as long as it takes until the job is well and truly done. No one should doubt that.
Thank you. Thank you.
Thank you. Nick Timmeros.
Thank you. Nick Timmeros, the Wall Street Journal. Chair Powell, a two-part question. What, if anything, would prompt the Fed to shift Treasury purchases toward the longer end of the curve, as you did with your prior QE programs? And does your guidance today on asset purchases foreclose the possibility that you could at some point lengthen maturities while simultaneously tapering the monthly purchase amounts?
Well, Nick, on the first part of the question, I wouldn't want to sort of talk about hypothetical situations. We look at our overall stance of policy. We look at overall financial conditions. We look at what's going on in the economy, different parts of the economy, and we ask ourselves, should we change our policy stance? We do that at every meeting. And we look at where financial conditions are now, and we feel that they are appropriate for now. Any time we feel like the economy could use stronger accommodation, we would be prepared to provide it. But right now we're providing a great deal, and we happen to think it's the right amount. And you mentioned, I think you're referring to the idea of maintaining the duration, but reducing the quantity, which is sort of what the Bank of Canada did. And that is something that we talked about in the last meeting and was addressed in the minutes. And I would say the views on that were mixed. Some thought it was an interesting idea, others not so much. I wouldn't say that that's something that's high on our list of possibilities.
Thank you.
Thank you. Victoria.
Hi, Victoria Guido with Politico. I wanted to ask about the 13.3 facilities. Chair Powell, you've said that you accept Treasury Secretary Mnuchin's interpretation of the statute of the CARES Act on what should happen with those programs. So first of all, I'm curious whether under a new Treasury Secretary, you will accept whatever legal interpretation they put forward for those programs. And then also, given that there isn't a statutory requirement for you to have financial backing from Treasury for 13.3 facilities, do you have any plans for any future facilities that don't require Treasury backing?
So on your first question, we really have not thought about that. We're very focused on. We have a lot to do now, and we have not focused on that question. And I really have nothing to add on that. Your second question is, sorry. If there no, we would have the ability. Certainly, we would have the ability to do facilities under 13.3, in some cases with no backing. But we can't do any 13.3 facilities without the approval of the Treasury Secretary, right? But we did some facilities. I think one of our facilities this time didn't have any Treasury backing, and I think some in the round of during the global financial crisis also didn't have any.
So, do you have any plans? Like, would you consider doing more facilities if that became necessary without Treasury backing?
I would say that we are. We have the authorities we have. We will use them if they're needed, and if the law permits us to do so. We would always do that. We do not have any plans for the future about this. We're very focused on getting through year end. we've been very focused on the issues that are right in front of us. And honestly, we're not planning on anything or having any discussions about what we might do down the road.
Thank you. Thank you. Steve Leisman.
Thank you, Mr. Chairman, and Happy New Year. I know how much you enjoy talking about fiscal stimulus, so let me ask you directly about fiscal stimulus. There's talk right now of a $900 billion fiscal stimulus program in Congress. Is that sufficient? Is that what you're looking for? You think that'll be sufficient for helping the economy? Finally, you talked about the idea of how concerning the recent surge is. I wonder if you could put some detail on that. How much concern do you have in terms of where could employment go? What could happen to GDP in the first quarter as a result of this surge? Thank you.
Okay, so on fiscal policy, I would just say a couple things. The case for fiscal policy right now is very, very strong, and I think that is widely understood, I would say now. The details of it are entirely up to Congress, but with the expiration of unemployment benefits, some of the unemployment benefits, the expiration of eviction moratoriums, with the virus spreading the way it is, there's a need for households and businesses to have fiscal support. And I do think that, again, I think that is widely understood. So I think it would be, I certainly would welcome the work that Congress is doing right now. It's not up to us to judge that work. It's really theirs. And I don't have a view for you on the size of it. It's it's obviously a substantial bill. On the surge, so it's a really interesting question. We have, and others too, have consistently expected there to be more economic, that cases would hold, growth in cases would hold back the economy more than it actually has. So we've overestimated the effects on the economy of these spikes we've been having. Now this spike is so much larger that I think forecasters generally do think that that this will have an effect on suppressing activity, particularly activity that involves people getting together in bars and restaurants, on airplanes and hotels and things like that. And you're starting to see that. In the high-frequency data, you're now beginning to see that show up. And I think this is the case numbers are so high and so widespread across the country that seems like it must happen. Now, how big will it be? We don't really know. There are a lot of estimates. The general expectation is you're seeing some slowing now, and you'll see the first quarter could well be. What we said is that coming months are going to be challenging. The first quarter will certainly show significant effects from this. At the same time, people are getting vaccinated. Now they're getting vaccinated, and by the end of the first quarter, into the second quarter, you're going to be seeing significant numbers of people vaccinated. And so then how will that play into economic activity? Again, we don't have any experience with this. You have to think that sometime in the middle of next year, you will see people feeling comfortable going out and engaging in a broader range of activities. And some people will be probably quick to do that. Some are doing it now without a vaccine, right, in many parts of the country. So nonetheless, my expectation, and I think many people have the expectation, that the second half of next year the economy should be performing strongly. We should be, we should be getting people back to work. Businesses should be reopening and that kind of thing. The issue is more the next 4 or 5 months, getting through the next 4, 5, 6 months. That is key, and clearly there's going to be need for help there, and my sense and hope is that we'll be getting that.
Thank you. Gina Smialek.
Hi, Chair Powell. Thank you for taking our questions. I was wondering if you could talk a little bit about house prices. They were mentioned in the most recent minutes as, potentially a valuation concern, especially as it related to your mortgage-backed security purchases. And you mentioned earlier today that the housing market looks more or less fully healed. And so I guess I wonder, are you worried about valuation pressures there? And if so, what can the Fed do to contain those?
We monitor basically just about every asset price in the economy, and housing prices are something that we've been monitoring. And you see them moving up. You see very high demand. This is the housing market that people have been expecting since 2010, and then Not many, when the pandemic hit, thought, oh, this is what will produce that housing market, but it has. Now, I would say from a financial stability standpoint, housing prices are not of a level of concern right now. That's just reflective of a lot of demand, and builders are going to bring forth supply. There's also a sense that some of this may be pent up demand from when the economy was closed, which would imply that once that demand is met, that the real level of demand will be more manageable. So it's a healthy economy now. We met recently with a bunch of home builders, and many of them in the business 30, 40 years, so they've never seen the likes of it. But no, housing prices themselves are not a financial stability concern at the moment. We will watch that carefully, but in the near term, I wouldn't think that that's an issue that we'd be concerned about.
Thank you. Edward Lawrence.
Thank you for the question. Mr. Chairman. So, with the actions that you've currently taken, how do you further fight a slowdown that you're seeing? We talked about the retail sales numbers are a little bit sluggish this month. The unemployment, the job growth has slowed down. Is there more the Fed can do to fight this, or is it now squarely in the Congress's realm?
There is more that we can do. Certainly, we can expand our asset purchase programs. We can focus them more on the longer end. There are a number of options we would have to provide more support to the economy. I would say, though, that in the near term, the help that people need isn't just from low interest rates that stimulates demand over time and works with long and variable lags. It's really support. We've talked about this as all of these government policies trying to work together to create a bridge across this economic chasm that was created by the pandemic. And for many Americans, that bridge is there, and they're across it. But there's a group for which they don't have a bridge yet, and that's who we're talking about here. It's the 10 million people who lost their jobs. It's people who may lose their homes. It's you see the many millions of Americans are waiting in food lines in their cars these days all over the country. So we know there's need out there. We know there are small businesses all over the country that have been basically unable to really function, and they're just hanging on. So, and they're so critical to our economy. So, and by the way, now that we can kind of see the light at the end of the tunnel, it would be bad to see people losing their business, their life's work in many cases, or even generations worth of work because they couldn't last another few months, which is what it amounts to. So we have more we can do, and I think more the issue is we're going to need to continue to provide support to this economy for quite a period of time, because the economy will be growing in expectation, should be growing at a fairly healthy clip by the second half of next year, but it's going to be a while before we really are back to the levels of labor market, the sort of conditions in the labor market that we had in early this year and for much of the last couple of years. So that's how I think about it.
Thank you.
Thank you. Howard Schneider.
Hi, Chair Powell. Thanks for doing this, and thanks, Michelle. Two quick questions. One, on the vaccine, do you have, or has the Fed modeled sort of a working estimate of when the U.S. might reach something approaching herd immunity? And secondly, if you could please connect with me the lack of movement on the decision to maintain the current pace and quantities of bond purchases, with the fact that the SEPs are showing 3 years with inflation not reaching 2%. Some might argue that you need to do more to start fixing those expectations and to let this drift and say, we're going to miss our target for another 3 years, doesn't show a very firm commitment to the new framework.
So in terms of the vaccine, yeah, we do estimates, but of when the United States would reach herd immunity, and they're going to be similar to what other people think. It depends on your assumptions, such as how many people will actually take the vaccine, and how fast will the rollout be. So it's assumption based on assumption based on assumption. But it's possible sometime in the middle or second half of next year. I'm not going to try to be precise because it's just another estimate. Our people are very good, but they're looking at the same data as other people are, so all the estimates are. It depends on what your assumptions are, but under a normal set of assumptions, it could happen as soon as the middle of next year. In terms of the inflation, a couple things. Your second question, I think you have to be honest with yourself about inflation these days. There are significant disinflationary pressures around the world, and there have been for a while, and they persist today. It is not going to be easy to have inflation move up, and it isn't going to be just a question. It's going to take some time. It took a long time to get inflation back to 2% in the last crisis, and we're honest with ourselves and with you in the SEP that even with the very high level of accommodation that we're providing both through low rates and very high levels of asset purchases, it will take some time, because that's what we believe the underlying inflation dynamics are in our economy. And that's sort of why one reason why we're concerned about inflation is that we see that, and that's why we have adopted the flexible average inflation targeting framework. That's why we're aiming for an overshoot, but we're honest with ourselves and with the public that it will take some time to get there. In terms of, would it really speed it up a lot to move asset purchases? I don't think that would really be. I think it's going to take a long time, however you do it. And, we've been having very long expansions since in the last several decades, because inflation has not really, the old model was inflation would come along and the Fed would tighten and we'd have a recession. Now, inflation has been low, and we haven't had that dynamic, and the result has been 3 of the 4 longest expansions in modern history, in recorded history. So, we're thinking this could be another long expansion, and that we'll keep what we're saying is we're going to keep policy highly accommodative until the expansion is well down the tracks, and we're not going to preemptively raise rates until we see inflation actually reaching 2% and being on track to exceed 2%. That's a very strong commitment, and we think that's the right place to be.
Thank you.
Thank you. Chris Rugaber. I'm sorry, Mr. Chair.
I'm just going to add, markets have actually found this fairly credible. If you look at inflation compensation and at the survey measures of when the Fed will lift off, everything has moved. There have been significant movements since we announced the framework in the direction that is consistent with the framework being credible to market participants. So I don't think it's something that I'm actually pleased by the reception it's gotten in markets, and markets have moved in ways that suggest it is credible.
Thank you, Chris.
Hi, thank you. Yesterday, I guess the Fed said that it's joining the International Financial Greening Group, and just wanted to see if you could expand on how the Fed is thinking about climate change and how it might affect Fed policy going forward. Specifically, I think Janet Yellen drew a distinction between considering climate change when it came to financial regulation. But how do you see that also potentially affecting monetary policy? Obviously, there have been criticisms of the Fed for buying bonds of oil and gas companies. But leaving that specific case aside, is there any way that climate change considerations could affect monetary policy going forward?
So you're talking about the Network for Greening the Financial System, which we joined this week. And I'll just say a couple things about that. So first, I'll just start by saying that we're going to move carefully and thoughtfully on developing an understanding of how climate change affects our work, including the areas you mentioned. We're going to do so with a great deal of engagement with all of our external constituencies, including the public and their elected representatives who are charged with our oversight. We'll do it with great transparency. Remember that we are a non-political agency whose goals and authorities to achieve those goals are set by Congress. We have great responsibilities and strong authorities that we'll use vigorously. We're not the forum where all the great issues of the day are to be hashed out, debated, and addressed, unless and only to the extent that those issues are directly relevant to our statutory goals and are addressable through our legal authorities. And because we have a narrow remit and because we stick to it, Congress has given us a precious grant of independence from direct political control. So society's broad response to climate change is for others to decide, in particular elected leaders. But so let me get to your question. What does all that mean for an issue like climate change? And why did we join the NGFS? So Congress hasn't explicitly assigned us or other financial regulators a role, and we're not among the agencies who contribute to the National Climate Assessment, for example. But climate change is nonetheless relevant to our existing mandates under the law, and let me tell you why. One of our jobs is to regulate and supervise banks and to look after the stability of the financial system. That's a responsibility we share with other agencies. The public will expect that we will do that. So we'll expect that those important institutions will be resilient against the many risks that they face. Credit risk, market risk, cyber risk. Climate change is an emerging risk to financial institutions, the financial system, and the economy. And we are, as so many others are, in the very early stages of understanding what that means, what needs to be done about it, and by whom. That's why 83 central banks have joined together to share research and identify best practices in this important emerging area. We've been attending NGFS meetings as an observer for more than a year, taking part in the work. We had discussed that it was probably time to join as a member. I'll just say that the financial system is really a global one. It's important that we work and discuss best practices with peer agencies around the world, especially in a field where we're just beginning to develop our understanding. You ask about monetary policy. I'll say this. We have historically shied away strongly from taking a role in credit allocation. In fact, our agreement with Treasury during the financial crisis from back in 2009 or 10 says that we will avoid credit allocation. It's something we've carefully avoided. So I would be very reluctant to see us move in that direction, picking one area as creditworthy and another not. So you asked about monetary policy. It's for now, I would say the real concern is the real place to focus for me is supervision of financial institutions and then financial stability concerns. You can see a connection there. Monetary policy, maximum employment, stable prices. It's less obvious to me. I can make the argument, but it's less obvious to me that those should be first order things that we would look at in connection with climate change. But I think there's work to be done to understand the connection between climate change and the strength and resilience of financial markets and financial institutions. I think that work is in its early days. And again, we'll be careful, we'll be thorough and transparent and engage with the public on all that.
Thank you.
Thank you. Rachel Siegel.
Hi, Chair Powell. Thanks very much for taking my question, and thank you, Michelle. I wanted to ask specifically about state and local aid. Just as one example, the governor of Illinois announced roughly $700 million in early anticipated budget cuts to close a budget deficit. And the latest bipartisan stimulus proposal that's being debated this week seems to be leaving out state and local aid at this point. And I'm just curious if you can give some detail about the damage that these budget deficits or the lack of aid specifically to state and local governments will have on the recovery, and specifically with the municipal lending facility set to expire, what more the Fed might be able to do to fill that specific hole. Thanks very much.
Okay, so the state and local governments, they provide important critical services, safety, fire, police, health, all kinds of things like that. They're really involved in people's lives. State and local governments are to a large extent. The decision whether to provide more fiscal support to them is entirely in the hands of Congress. And, they're in the middle of these discussions, and those are issues for them to decide. I would say that the picture is mixed. What's happened is if you're a state that has a significant exposure to tourism or to extracting energy from the ground, oil from the ground, or gas, you are probably, at least in those industries, feeling a significant loss of revenue. A number of other states have been surprised on the upside, and that's because goods sales, for example, property taxes don't move much year to year, and the kind of sales taxes on goods sales have been very high. Income has been more or less replaced by the CARES Act, fully replaced, more than in many cases. So the concerns that we had at the very beginning of really serious, deep shortfalls and massive budget cuts on the part of state and local governments have not yet occurred. What we're seeing is that it's different state to state. and some states are having significant difficulties, others not so much. The real concern, though, that still emerges is state and local governments are very large employers and one of the largest. And so far, since the pandemic began, employment has dropped by 1.3 million of state and local government. So it's a very large number of people to be out of work from just that one source. It's actually significantly more than lost their jobs during the global financial crisis. So that is a significant part of that group is in education. So when the schools reopen, a significant part of that 1.3 million would go back to work. Nonetheless, it's a concern. We're watching carefully to understand why that many people have been let go and what really are the sources. So we're monitoring it carefully, and it's a mixed picture. And I just have to leave the question of what to do with fiscal policy on this to Congress.
Thank you. James Politi.
Thank you, Michelle, and thank you, Chair Powell. You and the Fed have consistently said that the Fed was ready to provide the economy with more monetary support if needed, and really stressed to policymakers generally that the dangers of not doing enough outweigh the risks of doing too much in a situation where there's so much suffering in the economy. The guidance today sort of cements asset purchases for a longer period of time, but is not a big new easing step. Why was now, with the short-term outlook deteriorating due to the new coronavirus surges, not the moment for a big new easing step? And is it because of the medium-term outlook improving, or is it because the Fed just doesn't have the capacity to sort of build that bridge over the next 4 to 5 months for the people who are struggling?
Right. So I could go back, James, to what I said earlier, which is this is a very, very large asset purchase program. It's providing a tremendous amount of support for the economy. If you look at the interest-sensitive parts of the economy, they're performing very well. The parts that are not performing well are not struggling from high interest rates. They're struggling from exposure to COVID. In a sense, these are the businesses where that are really hit hard by people's reluctance to gather closely. So we do have the ability to buy more bonds or to buy longer term bonds, and we may use it. I'm not saying we won't use it. It may well come to using that. But also I would also note, though, monetary policy works with long and variable lags is the famous statement. So we think that the big effects from monetary policy are months and months into the future. So this looks like it looks like a time when what is really needed is fiscal policy, and that's why it is a very positive thing that we're getting that. So we remain open to doing to either increasing the size of our asset purchases if that turns out to be appropriate, or to just moving the maturities, moving to buying longer maturities, because that also increases accommodation by taking more duration risk out of the market. But we think our current stance is appropriate, and we think that our guidance on asset purchases today will also provide support to the economy over time. Again, what we've done is we've laid out a path whereby we're going to keep monetary policy highly accommodative for a long time, really until we reach very close to our goals, which is not really the way it's been done in the past. So that's providing significant support for the economy now. We don't think the economy suffers from a lack of highly accommodative financial conditions. We think it's suffering from the pandemic and people wanting to not engage in certain kinds of economic activity. And we expect that with the virus that will improve, that condition will improve. Nonetheless, again, we are prepared to use our tools. We will use them at such time and in such amounts as we think would help.
Thank you. Scott Horsley, NPR.
Thank you, Mr. Chairman. Some forecasters have suggested that there is a lot of pent-up demand for travel and entertainment and services and the like that might stop being pent up in a hurry if we do get to a point where the vaccine is widely distributed, and that the beaten down service sector might have trouble meeting that demand in a hurry. How might that affect inflation in your mind? And would that be just a transient problem or something that might warrant closer scrutiny?
So that has all the markings of a transient increase in the price level. So you can imagine that as people really want to travel again, let's say, that airfares go, I'm just imagining this, right, that they go up. But what inflation is a process whereby they go up year upon year upon year upon year. And given the inflation dynamics that we've had over the last several decades, just a single sort of price level increase has not resulted in ongoing price level increases. And that was the problem back in the 1970s. It was the combination of two things. One, when unemployment went down and resources got tight, prices started going up. But the second problem was that increase was persistent. There was a level of persistence. So if prices went up 6% this year, they'd go up 6% next year because people would internalize. I mean, really, that's what happens is people internalize that they can raise prices and that it's okay to pay prices that are going up at that rate. So that was the inflation. Those were the inflation dynamics of that era. Those dynamics are not in place anymore. The connection between low unemployment or other resource utilization and inflation is so much weaker than it was. It's still there, but it's a faint heartbeat compared to what it was. And the persistence of inflation, if you get for example, oil prices go up, and that'll send a temporary shock through the economy. The persistence of that into inflation over time is just not there. So what you described may happen, and of course we would watch it very carefully. We understand that we will always be learning new things from the economy about how it will behave in certain cases. But I would expect, though, going in that would be a one-time price increase rather than an increase in underlying inflation that would be persistent.
So not the kind of thing that the Fed would be trigger happy to respond to.
No, definitely not.
Thank you, Michael Derby.
Longer question, but what I wanted to ask was, given the size of government borrowing and different regulatory changes in the financial sector, do you think that the Treasury market long run can operate smoothly without some sort of active Fed presence? Buying Treasury debt. I'm referring back to what one was made about Randall Quarles. He had some questions about it, so I wanted to know where you stood on that issue.
Right. So you were breaking up a little. I think I got the sense of it, though.
Okay.
Yeah, I don't think it's at all a foregone conclusion that there needs to be a permanent Fed presence, and we certainly don't. That's not something we're planning on or intending. Right now, we're buying assets because it's a time when the economy needs highly accommodative monetary policy, and we think our asset purchases are one of the main delivery mechanisms for that, the size of the balance sheet. There's lots of demand for U.S. Treasury paper from all over the world. And I think we need to be thoughtful about the structure of the Treasury market and look at ways to make sure that the capacity is there for it to be handled by the private sector. And there's quite a lot of work going on that front. But I don't presume at all that this is something that needs to be where the Fed needs to be in there at all. I would think that this should be handled by the private sector and can be. Institutions need to be able to hold this paper, and there may be a central clearing angle that would net a lot of risk. That's yet to be proven. There are a lot of things that are being looked at right now.
Thank you. Hannah Lang.
Hi. Thanks so much for taking our questions. As you know, the pandemic has really disproportionately impacted small and medium-sized businesses, and the Fed launched a few efforts this year through its 13.3 programs to reach out to those companies. But considering that some of those programs are ending, is there anything else that the Fed's actions can do to provide support to those companies, or is that solely Congress's domain?
I think the main thing that those companies need is a robust recovery, a strong, robust recovery. And so we contribute to that through highly accommodative monetary policy, through accommodative financial conditions that are supporting economic activity. Health authorities are contributing to that through management of the spread of the virus, and now through vaccines and the delivery of those vaccines. And Congress contributes to that by helping them make it through this very difficult time. And I think my understanding is that there's support for small businesses in what's being discussed on Capitol Hill. I would certainly think that would be something well worth looking at.
Thank you. Paul LaMonica.
Hi, Chair Powell. I was wondering if you've had any conversations yet with any members of the incoming Biden administration, particularly Janet Yellen, who obviously you can share some similar experience in running the Fed. So just curious to get your thoughts on how the relationship with Treasury and the new administration might differ than the past couple of years.
So, we've had, and I've had sort of the typical meetings with the transition team for Treasury. They've met with quite a lot of people at our agency and other agencies, and really it's about learning what we do. I really have only spoken to former Chair Yellen to congratulate her on being nominated, and just to say that I look forward to working with her. I did work very closely with her for 5 years before she left, and have stayed in touch, So I did that, but I have not discussed, policy with her, and I'm not going to do that until she's confirmed.
Great. Thank you. Jeff Cox.
Yes, Chair, thank you for taking the question. You've been asked this question before in various forums. I'm going to try it a little bit differently now. The equity market and the bond market seem to be telling two different stories about where things are heading. We continue to on the stock market. Bond yields remain very low. Does that concern you at all? And are you getting any more concerned about asset valuations in light of the highly accommodative Fed policies?
You were breaking up, but I think I got that. I think I got it. So, financial stability. We look at a broad range of things. We actually have a framework so that we can, evaluate changes in financial stability over time, and so that the public can evaluate whether we're doing a good job at it. So what do we look at? Asset prices is one thing that we look at, and we published a report a few weeks ago on that. Maybe it was a month or so ago. Anyway, and I think you'll find a mixed bag there. It depends with equities. It depends on whether you're looking at PEs or whether you're looking at the premium over the risk-free return. If you look at PEs, they're historically high, but in a world where the risk-free rate is going to be low for a sustained period, the equity premium, which is really the reward you get for taking equity risk, would be what you'd look at, and that's not at incredibly low levels. So, which would mean that they're not overpriced in that sense. Admittedly, PEs are high, but that's maybe not as relevant in a world where we think the 10-year Treasury is going to be lower than it's been historically from a return perspective. We look at we also look at borrowing leverage of financial institutions. We spent 10 years, and the banks spent 10 years building up their capital. So far, they've been a source of strength through this crisis, and their capital has held up well. We look at leverage in the non-financial sector. That's households and non-financial corporates. Non-financial corporate leverage is high. We've been watching that, but rates are really low. So companies have been able to handle their debt loads even in weak periods because rates are quite low. Your interest payments are low. Defaults and downgrades have declined since earlier in the year. Households came into this very strong, and there certainly has been a hit there for people who are unemployed. But with the CARES Act, Congress replaced a lot of lost income. It's very important that the economy gets strong again. I mean, the ultimate thing to support financial stability is a strong economy. The last thing is really funding markets. We found that there was a lot of unstable funding for companies, particularly financial companies, and that's down to a very low level these days. So the broad financial stability picture is kind of mixed, I would say. I would say it's, asset prices are a little high in that metric in my view, but overall you have a mixed picture. You don't have, a lot of red flags on that. So, and it's something that we monitor essentially ongoing, almost daily. We're monitoring these prices for that and have published our framework, and we'll be held accountable for what we saw and what we missed. So we work very hard at it.
Thank you. And for the last question, we'll go to Michael McKee.
Mr. Chairman, I have a couple of questions about the fiscal support for the economy. This year's budget deficit is $3.1 trillion, and Republicans have argued they don't want to spend more because we can't afford it. So I'm wondering if you can make the case for how much we can afford. At what point do deficits and the debt start to have an impact on the economy or on interest rates, and how would we know when we get there?
So people who run for elected office and win, they're the ones, the reward is they get to make those very difficult decisions. And, so we're not charged with providing fiscal advice to Congress. But I would just say as a general rule, it is important to be on a sustainable fiscal path. For my way of thinking and many others, the time to focus on that is when the economy is strong, and when unemployment is low and taxes are pouring in, and there's room to get on a sustainable path because the economy is really doing well. You're still now in the some part of an economic crisis, and the fact that Congress is debating a fairly large bill today suggests that something fairly substantial is going to get done. We hope, but what's being discussed is of some size. In terms of what is a sustainable level, I think it's the question is, we've always looked at debt to GDP, and we're very high by that measure. By some other measures, we're actually not that high. In particular, you can look at the real interest rate payments, the amount of what does it cost. And from that standpoint, if you sort of take real interest costs of the federal deficit and divide that by GDP, we're actually on a more sustainable fiscal path if you look at it through those eyes. Again, these are issues for Congress, but I'll just say in the near term, I think the case for fiscal is strong, and I'm certainly hoping. I think it would be very good for the economy if we did get something soon.
Well, an argument for continuing to spend is that low interest rates make it affordable. Do you worry you get into a situation where you would have congressional interference in monetary policy making, or at least feel significant political pressure to keep rates low because the country can't afford to pay a significant interest bill?
Yeah, I think we're a very, very long way from that. The Congress has given the Fed independence on the condition that we stick to our knitting. We try very hard to do that, I think that's what people call fiscal dominance, and I think we're just a very, very long way from that. I think if we do our jobs well and support the economy and achieve maximum employment and stable prices, keep the financial system stable, I don't think that is something that I would worry about. Certainly not in the near term.
Thank you very much.
Thank you.
Good afternoon. You've been listening to Fed Chief Chair of the Federal Reserve, Jay Powell, in his last press conference and last FOMC meeting of the year, just as snow starts to fall here,
We're seeing it here
in my home,
too.
just outside the window. And Carol Master along with Tim Stanovic. And Tim, just some of the headlines that stood out for me. I think he talked about asset prices, mixed picture, not a lot of red flags. He did say, I think some are high in his opinion. He did talk about having typical meetings with the Biden transition team, but he won't discuss policy with the nominee for Treasury Secretary, Janet Yellen, former Fed chief, until she is confirmed. I also think it was interesting he talked about possible price increases, right? The concerns about inflation, and said that, he does expect that there could be a price boost for travel, that we might see that after the economy reopens and we all get back to kind of quote unquote normal. But he said he wouldn't respond to that necessarily in terms of Fed policy because he would see that as transient and as a one-time price increase. increase.
Yeah, I thought that was really interesting too, Carol, because he drew this comparison, of course, with inflation in the late 70s. And what he said was that inflation then was year after year after year. And he sees that even with a vaccine and pent-up demand for things like travel, for things like vacation, that would be transient, as you mentioned. So it would have this transient impact on prices rather than this continuous effect on inflation on an ongoing basis. So I thought that was a really interesting question.
And both you and I, we were kind of being back and forth with one another. I thought, and I know he's made lots of comments about many things, and I have certainly followed his press conference after these Fed meetings, but I thought what was really striking too is the comments he made on climate change. He says it's relevant to their existing mandates under the law. He said we have to look at banks' resiliency. Climate change is an emerging risk, and we are in the early stages of understanding what that means. But again, relevant to our mandates under the law. So I thought that was interesting. I also thought he said the extreme state budget shortfalls have not yet occurred, and that the concern is that state local governments are large employers, and that impact could certainly weigh on the economy and really weigh on individuals who are struggling at this point.
It also did seem that he sort of had this message for Congress, especially at the end right there.
Totally.
This message for lawmakers saying, hey, the time is now. And he did say the case for fiscal stimulus is strong. And of course, right now we're at a moment where for months they've weighed back and forth, and we're still waiting for that stimulus package to emerge.
And I feel like it's certainly something we've heard from Jay Powell and certainly his team there at the Fed. Just to wrap it up in terms of some of the highlights, Tim and I noticed the Fed chair, Jay Powell, saying we will keep Fed policy, quote, highly accommodative until we're well down the tracks. And he said that it could be another long expansion afterwards based on trends. So I think that was kind of interesting in terms of starting to look forward. That's what they're going to do now, but also looking at the outlook. All right, you are listening to Bloomberg Business Week. That is a wrap up of the Fed chair, his press conference, his statement, and the last Fed policy meeting of the year. Let's get to Charlie Pellet, though, for a check on the world of business and some market reaction.
Hi, thank you very much. Well, hello there. We've got 28 minutes to go ahead of the closing bell. Market reaction. The Dow turns around. Stocks trading at records, at least the S&P and NASDAQ, as Fed Chair Jay Powell spoke here on Bloomberg Radio. Do want to begin with a headline out of Washington. Senate Majority Leader Mitch McConnell says, quote, we're still talking, and I think we're going to get there. Right to the numbers. Give you the story in a moment here. S&P at a record, up 14 now, up 0.4%, 3709 on the S&P 500 index, bringing its year-to-date gains to 14.85%. NASDAQ at a record, surging 90 points now, up 0.7%, bringing its year-to-date gain to 41.4%. The Dow up 28. That is a gain there of just about 0.1%. 10-year down 3/32, 10-year yield 0.91%. Gold is up 0.5%, 18.63 the ounce, and crude pushing higher again today, up another 0.4%, 47.81 a barrel on WTI. The Federal Reserve today strengthened its commitment to support the U.S. economy, promising to maintain its massive asset purchases program until it sees, quote, substantial further progress in employment and inflation. And at the news conference carried live right here on Bloomberg Radio and Television, Fed Chair Jay Powell was also asked about the need for stimulus.
The case for fiscal policy right now is very, very strong, and I think that is widely understood, I would say now. The details of it are entirely up to Congress, but with the expiration of unemployment benefits, some of the unemployment benefits, the expiration of eviction moratoriums, with the virus spreading the way it is, there's a need for households and businesses to have fiscal support.
And again, recapping, U.S. stocks climbing to a record 37.11 now on the S&P, up 16. That's a gain of 0.5%. 10-year 0.92% right now. NASDAQ up 0.7% at a record. The Dow up 0.1%. I'm Charlie Pellet. This is Bloomberg.
And you are listening to Bloomberg Business Week on this Fed Wednesday. Carol Masser along with Tim Stanovic of Bloomberg Quick Take. And as expected, leaving rates unchanged, but we did hear a lot from Fed Chief Jay Powell, certainly as Charlie highlighted there, about expectations, hopes, if you will, for fiscal stimulus, something that is still winding its way slowly through Congress. And we'll see if ultimately we get something, Tim, before the end of the year.
Slowly is right, Carol.
really slowly.
We're counting down the days until something needs to happen.
Yeah, exactly, right? And there's not much left here in 2020. Hey, let's see what our roundtable has to say about this Fed decision and really that Fed press conference with Jay Powell. Steve Blitz back with us, Chief U.S. Economist at TS Lombard, on the phone in New York City. Also, Bloomberg Economics Senior U.S. Economist Yelena Shaletyeva. She's on the phone in Long Island. Yelena, let me start with you briefly. I want to get from both of you the highlights in the press conference, things that you think investors, our Bloomberg audience, really need to take note of.
Absolutely. I think what was very interesting from the press conference is that Chair Powell dismissed any expectations for a near-term change in the pace or the composition of asset purchases. He noted that financial conditions are appropriate for now, and the Fed is providing enough accommodation, substantial accommodation. So shifting towards longer-term maturities by simultaneously reducing the pace of purchases, something that was hinted in the latest FOMC minutes, it's not high on our list of priorities, he said. So I think what was very interesting in the whole FOMC communique was that they did not hint at any more aggressive pace of purchases going forward. They did actually refine its communications in terms of what to expect in terms of asset purchases going forward, but they were not aggressively saying that they will increase the pace in the near term.
Steve, I want to bring you into the conversation, Chief U.S. Economist at TS Lombard. Look, I had a chance to look at your note in your reaction right at 2 o'clock. You said not very interesting, nothing very interesting in the FOMC statement. What about when it comes to Fed Chair Powell's press conference? Any more color or anything else that you found, anything in there that you actually found interesting, surprising?
Well, yes and no. I think, first of all, I think he basically waved again the white flag and said, look, near term, over the next 4 or 5 months, the bridge to, the vaccinated world and the ability for the economy to get there in whole rests with fiscal policy, not monetary policy. That, what's suffering is not interest rate sensitive, and therefore for them to do anything more isn't going to help.
I mean, reading between the lines here, that's a message to Congress and to lawmakers. That's like, hey, get something done now.
I think it's a sledgehammer, not between the lines. But the other part of his message, though, I think as long as we're talking, you see your audience, our market participants, is this. They're also making the bet that when the recovery occurs, it's going to be another extended growth, low inflation environment.
I thought that was really interesting, Steve. I thought that was really interesting that he even actually put that out there.
Yeah, and so the question is, as a market participant, do you believe that the next cycle is going to have the same dynamic as the last one? I would argue the answer is no, and that their timeline of when they're actually going to begin to react is a lot shorter than what they're laying out there. But of course, there's no way for them right now. There's no way for right now that they would alter that because it would be counterproductive to their messaging. So I understand that, but as a market participant, are you going to bet with that forward curve, or are you going to bet against that? And I think it makes more sense to bet against it, that the economy is going to end up being stronger, and hence they're going to have to react sooner.
Well, Yelena, this is kind of your world, too, in terms of watching the economy. I mean, could we be setting the stage for another kind of very long, protracted, kind of slow growth, low inflation economy, which is one that we know market investors just love, certainly equity investors?
Well, I think I totally agree with that. And I think despite some, expected rebound, probably in the second half of this year, it will take time for the labor market to get fixed. So look at what has happened already. Yes, there was a quick rebound in economic growth, but less of a rebound in the labor market. And that's what we are facing going into the next year. I think in terms of inflation, that was very interesting as well. I think the changes to the summary of economic projections reflecting stronger growth lower unemployment rate, but no substantial changes to inflation projections actually highlight that the Fed is not expecting much of high inflation going forward. So that tells me that they're not that optimistic with respect to developments in the labor market going forward.
Yelena, what would have to happen for the Fed to raise interest rates in 2021?
Oh my God.
That's a tough one. We're not expecting interest rates until 2025, by the way. So
even further than the Fed said today.
Yes, but the consensus is still pretty in line with no interest rate increases. Just a few of participants are expecting those. But I think we need to see that the output gap to close, and we will need to see inflation expectations picking up substantially. That will not happen without substantial and sustainable increase in prices going forward. So I think we are ways away from the first rate increase. And by the way, we do not expect a tapering of asset purchases until 2022.
But listen, Tim brings up a good point. And, I do wonder, Steve Blitz, is there something out there, an outlier that we could miss, or that you're thinking about significantly? It sounds like you're a little bit more tempered, but something significantly on the downside or significantly on the upside. I mean, we are living in unusual times this year, certainly where we saw, a drop off like no other in the economy and a bounce back like no other in the economy. And we know the way back is usually much more difficult. But is there something out there, an outlier, when you get your team together and you're like, don't forget, this has still got to be on your radar?
The labor market. I think if we see a significant improvement in jobless rate and as well as a significant improvement in participation, that will result in significant growth in personal income and consumer spending, like way better than the market and economists' expectations, that could incur some high inflation quicker. So that's something to watch.
What about Steve for you?
Yeah, I think that the key thing here is that, first of all, it's not your typical recession because it's been in effect falsely created. And it's falsely created in the sense that we asked a big part of the economy to shut down. And that part of the economy eventually reopens. If you look at the last 10, 20, 25 years, what Powell's essentially expecting is for a similar pattern of growth, namely a lot of high-end growth and a lot of low-end growth in the labor market. If instead, because of COVID and everybody wanting to move someplace else, you get more and reshoring of economic activity, you get higher construction employment, higher manufacturing employment, higher office administration employment. It's not going to matter in 2021, but because then you're going to see a lot of the lower wage workers coming back as restaurants, everything comes back online. But in 2022, you're going to see the return of a much higher level of average hourly earning growth than what, relative to the unemployment rate than what we saw in the last recovery. And the Fed all of a sudden is going to be looking at from their perspective, not mine, but from their perspective, a return of the Phillips curve. And so I think that at the very end of 2022, first of all, I think at the end of 2021, they taper, if not end the asset purchases, and by the end of 2022, you get your first little increase in the funds rate.
All right, we got to leave it there. Hey, guys, thank you so much. Have a good holiday, Steve. And Yelena, you too, if we don't catch you before the new year, although I'm guessing we probably will. Steve Blitz, Chief U.S. Economist at TS Lombard, and Bloomberg Economics Senior U.S. Economist Yelena Shaletyeva. All right, right now that you are definitely up to speed on the Fed and the Fed meeting today, let's get an update, though, on world and national news. For that, over to D.C. and Nancy Lyons. Hey, Nance.
Hey, Carol. Progress is being made on a new coronavirus relief bill with promises made on the Senate floor today by Majority Leader Mitch McConnell.
We committed to continuing these urgent discussions until we have an agreement. And we agreed we will not leave town until we've made law.
Those familiar with the negotiation say the package does include stimulus payments to individuals and supplemental unemployment insurance, but it excludes liability protections and direct aid for state and local governments. Well, a powerful member of the Senate is getting behind an investigation of President-elect Joe Biden's son.
Senate Judiciary Chairman Lindsey Graham is calling on the Justice Department to appoint a special counsel to investigate Hunter Biden's business dealings in Ukraine and China. Graham says he hasn't spoken with President Trump about it, but says it would be a good idea to name one. Attorney General William Barr is resigning next week. It would be up to his incoming acting successor, Jeffrey Rosen, to decide whether to name a special counsel. The Biden transition team already confirmed last week the president-elect's son is under a federal criminal tax probe. Graham says a special counsel should go beyond that. In Washington, I'm Nathan Hager, Bloomberg Radio.
A major winter storm is impacting the eastern third of the U.S. Parts of New York, Pennsylvania, Connecticut, and New Jersey could see over a foot of snow. New York City Mayor Bill de Blasio says it could be the biggest snowstorm in the city for years. Jeff Draper runs a snow removal business in Westwood, Massachusetts.
Make sure the load is stopped, make sure everything's got fuel, make sure your employees know they're coming, what time they stop.
The storm has forced the cancellation of hundreds of flights. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg. Now let's check in with Charlie Pellet, who has a business flash.
Thank you very much. Here's what's going on. Nothing frosty on Wall Street right now. We've got the S&P, we've got NASDAQ, both trading at records. The Dow fluctuating, 15 minutes to go ahead of that closing bell. Stocks advancing on speculation. Lawmakers are getting closer to a stimulus deal aimed at reviving the U.S. economy. Treasuries fell as the Fed disappointed some traders who expected changes to the composition of bond purchases. We begin with the 10-year down 430 seconds. 10-year yield now 0.92%. The S&P up 12 to a record 3706 right now, a gain of 0.3%. NASDAQ pushing higher. Any close higher today will be a record for NASDAQ, up 81, up 0.7%. As I mentioned, the Dow fluctuating between gains and losses. Little change right now, down by 2 points. And with more on today's Fed meeting, here's Bloomberg's Vinny Del Giudice.
Fed officials are wrestling with the economic impact of the coronavirus and voted to hold the central bank's benchmark interest rate near zero. They'll continue to buy bonds, too, until there's substantial progress reviving the economy. But they refrain from tweaking the level of bond buying, which is aimed at steadying business conditions and financial markets. So for now, the Fed won't be shifting toward longer-term maturities. Vinny Del Giudice, Bloomberg Radio.
Bitcoin has surpassed $20,000 for the first time. Bitcoin right now at $20,830. Recapping stocks at a record. S&P up 12, up 0.3. I'm Charlie Pellet. That's a Bloomberg Business Flash.
Good thing you bought all those Bitcoins, Charlie Pellet.
Without a doubt, sharing it with you, taking you out tonight.
Good. And then we're going to get back to cruising in 2021.
Works for me.
All right, Charlie Pellet, thank you so much. You are listening to Bloomberg Radio.
Okay, so can I?
I don't even think I have
I'm
to.
so scared. Is it Phil Collins?
No. I was gonna.
Kind of in that era.
Okay.
Is it Steve Winwood?
Yes, it is.
And I didn't even have to cheat. Woohoo!
There you go.
But good job,
Dave,
Tim.
Yeah, thank you. Dave knows I don't cheat because I don't get it right ever.
I actually saw Winwood with Clapton together, and it was a really cool concert.
Yeah, that was a couple of years back.
Yeah, at the Garden.
At the Madison Square Garden?
Yeah, on the floor. It was very good. It was a really cool concert. Because they go way back.
Absolutely. All the way back to the 60s when Winwood was the lead singer in the Spencer Davis Group and Clapton was playing with Cream. And before that, the Yardbirds.
The Yardbirds, he says it. Yeah, it's a long time. Well, listen, Clapton, right? He's in the Rock and Roll Hall of Fame. John and I were just talking about this last night. Is it 3 times because of all the different groups he's been a part of?
Something like that.
Yeah.
I'd have to go back and check to be sure. But yeah, I mean, he's definitely got his place. And
Tim, we still love you.
I'll get it one of these days.
You're
okay?
doing it, but you were close. Collins was like, that was good.
Little do you know, every night I go home and I just listen to classic rock. Okay.
Do you
now?
really?
Yeah, just so I can get this right.
I love it.
I don't believe that for a minute. It's like trying to study for. It's like trying to study for Jeopardy. I mean,
You can't study for it. You can't study for the song of the day.
No,
All right.
you cannot.
So
All
what do you got?
do is try and understand why I picked it, and in this case, it's because there is a split of sorts in the equity options market. You know, yesterday I had that chart from Charles Schwab.
Everybody loved it. Everybody loved it.
Absolutely. You know, talking about the surge in call option trading. But of course, that's just one side of the story, right? Call options give you the right to buy a stock or, in fact, an index, you know, something like that. There are also put options, which, you know, they rise in value when share prices, indexes fall. So if you compare trading in those contracts, you know, the puts and the calls, it's typically a put-call ratio, so it's more like an indicator of skepticism than anything else. You get a sense of how people are viewing the underlying assets, and you get a very different picture when you look at the put-call ratio for company-specific options than you do when you look at the ratio for stock index options. And it's a point that Variant Perception Research highlighted in a Twitter post yesterday. So I went back, looked at the numbers, and you find out that the put-call ratio for stock-specific contracts is at its lowest level since April 2000, based on a 20-day moving average, the same gauge that they used yesterday looking at the call options. Now, you run that same analysis on stock index options, and you find out the ratio is at its highest level in 9 years, or close to it at this point. It got there in mid-November.
Right.
So, you know, the way that people are looking at the broader market doesn't sort of match up to what's happening with individual stocks. So, you know, when you talk about rampant speculation like the folks at Charles Schwab did, they're really focusing in on the stock-specific contracts. So that's a key point. And if you want to know more, folks, send me an email. I'll get you the chart. The explanation goes with it, and everything I do going forward. The email address is dwilson@bloomberg.net. That's dwilson@bloomberg.net.
All right, good stuff, Dave. Thank you so much. You are listening to Bloomberg.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. Just drive, baby.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
Yeah, let's get right to it. Time for the Drive to the Close. Randy Watts back with us, Chief Investment Strategist at O'Neill Global Advisors. He's with us once again on the phone in Miami. Randy, good to have you here with Tim and myself. Hope you're doing well, and I feel like there's so much to talk about. So where shall we begin? I'm curious, the Fed, the meeting today, anything that you think is just really standing out for you?
I mean, I think well, first of all, thanks for having me back.
Yeah.
Second, I'll try to make it quick so you guys get out of there before the snow really starts in New York. With regard to the Fed, you know, I really think there were a couple of things. The first is that they're committed to continuing the bond buying. I'm sure you've talked about some of this on the show already. They said they'll increase asset purchases if the economy slows. So what the bulls wanted to hear today, they got, right? The Fed is committed. They're going to keep buying bonds, and they're going to do more if they need to. The balance sheet's at $7.3 trillion. That doesn't seem to bother them. They're willing to let it keep going.
What's the market expecting from Congress right now? Because we know, and we just heard from Mitch McConnell, Senate Majority Leader, that they're close, but not yet.
I mean, they expect this, you know, $900 billion bill. They expect it bill before the end of the year. They would like to see some relief for small business. I think the current version does include direct payments to consumers. I think that's needed. I think, again, as I've said before, the number one thing that is not focused on enough is the damage being done to small business. And you can see that particularly in Manhattan, where so many small businesses and restaurants and bars are going out of business.
Yeah, it's just devastating. It kind of breaks my heart. Anytime I'm kind of going through New York, it's just one boarded up or closed retail front after another, restaurants in particular. Randy, one thing that really stood out for Tim and me today in listening to the Fed chairman was what he had to say about climate change. And I love, you just put out an article at the end of November in Forbes, how to invest in the coming alternative energy boom. I think that there is, and many people are thinking about this, that we are at this interesting critical time where there's a lot of money being spent by global governments to kickstart the global economies, and that we can do it in a thoughtful, deliberate, environmentally conscious way. And I'm just curious how you see it.
I'd say three things. First, I feel like clean energy, like I mentioned in the article, it's like biotechnology in 1990. In 1990, biotechnology really got going. Amgen had those two major drugs and the whole sector took off. I think you're looking at a 30-year cycle here for clean energy. If you look at both the Biden administration and the European Commission overseas, both of them want to get their respective economies to basically carbon neutral by 2050. So if that's going to happen, that's an awful lot of spending. The Biden administration wants to spend $400 billion initially over 10 years. In Europe, it's even bigger. They want to spend €1 trillion over 10 years. So there's going to be a ton of spending. And then the third point is that if you look at new builds, so brand new builds for power generation, solar and wind are now actually cost effective. They are as low cost as the lowest cost fossil fuel. So if the cost is the same, why wouldn't you do clean energy?
So can I just follow? So then traditional oil, carbon, the big integrated oil companies, would you just run from them? I know they're also getting involved in alternative energy.
I think they need to get involved. I think some are transitioning quicker than others. I think besides the integrated, you can also look at things like utilities. FPL here in Florida has been very aggressive in terms of increasing its clean energy exposure. But I think you want to be with the companies that are really committed to it and have already started a transition, not the ones that are going to be late to the party, because it's going to hurt them or it's going to be expensive for them to catch up.
Well, one of those companies that you certainly have on your list is Tesla. This company has just had an amazing year. It's up more than 645% so far this year. It's unbelievable. Is the party over, though? Is there still room to get in on this?
I think it's a question of timing, right? So they're the largest electronic vehicle manufacturer in the world. They've got 16% share of the EV market, but they've only got 4% of the total market. So they have a lot of room to grow. Their energy storage business is growing about 45% a year, but it's only 7% of revenue. However, let's remember the stock's going into the S&P on December 21st. That's caused a lot of forward buying in the stock. I think if I owned it, I would hold it. But if I didn't own it, I'd really be looking for a better chance to get in sometime in the first or second quarter of next year. And that really, I think, goes for a lot of stocks. If you look at the market right now, technically, it's trending up along a rising 50-day moving average. But on an individual basis, there's an awful lot of names that are very extended from proper entry points, very extended from their 50 and 200-day moving averages. And I think there are a lot of names out there where people should be taking some profits because they're probably going to get a better chance to buy the stocks back in the first half of the year.
And I know there's a lot of other names, Randy, in the alternative energy space that you're looking at, Enphase Energy, Solaria. So we're going to have you come back and join us again because we'd love to dig a little bit more deeper into the space. Randy, have a great holiday, a safe holiday, and Happy New Year, and look forward to talking with you in 2021. Randy Watts, Chief Investment Strategist at O'Neill Global Advisors, on the phone in Miami. Interesting to hear what he had to say about Tesla.
Yeah, and
right?
he said he wanted us to be able to get home because of the snow. Not snowing in Florida right now.
No, it's not.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. There you have it. Sound of the closing bell at the New York Stock Exchange. As we wrap up trading on this Fed Wednesday, December 16th, folks from Nuveen virtually ringing that closing bell as we await the latest numbers out of office furniture maker Herman Miller and home builder Lennar. Looking at records today for the NASDAQ Composite Index, S&P misses by a couple of decimal points, was trading at a record right into the closing bell there, but no record today for the S&P. Indeed, a record for NASDAQ. Let's begin there. NASDAQ Composite Index up 63 points to 12,658, up by 0.5%. We've got the S&P 500 Index 3701, the record 3702 back on December 8th. The S&P up 6 today, up 0.2%, and the Dow Jones Industrial Average down 44 at the close, drop there of just about 0.2%. 10-year down 430 seconds, 10-year yield 0.92%. Gold up 0.6% at $18.64 the ounce. West Texas Intermediate crude up 0.5%, $47.84 a barrel. Stocks climbed on speculation that lawmakers are getting closer to a stimulus deal aimed at reviving the world's largest economy, and treasuries fell as the Federal Reserve disappointed some traders who expected changes to the composition of bond purchases. Randy Watts is with O'Neill Global Advisors, and he was our guest moments ago right here on Bloomberg Business Week.
So what the bulls wanted to hear today, they got, right? The Fed is committed. They're going to keep buying bonds, and they're going to do more if they need to. The balance sheet's at $7.3 trillion. That doesn't seem to bother them. They're willing to let it keep going.
Tilray and Afria agreeing to combine their operations, forming a new giant in the fast-growing cannabis industry. Tilray shares higher today, up by 18.5%, but a pullback for Afria, lower today by just about 0.9%. Recapping, S&P up 6. That was a gain of 0.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Wild thing, think you move me. I got a few moves I know you'll like. Shaking all over.
Bloomberg Business Week. Movers and shakers.
Shaking. Let's do it.
On Bloomberg Radio.
All right, yeah. Time to take a little bit of a deeper dive into today's trade on this Fed Wednesday. Carol Massar along with Tim Stenovic, both of us working from home, kind of getting ready for whatever kind of snow comes our way. Let's do a little bit of a deeper dive here because we were certainly glued to, obviously, what the Fed chairman had to say in that press conference. Charlie breaking down those final numbers. S&P 500, 210 names higher in the S&P 500 today, 295 lower, 1 unchanged. And if I look at those major industry groups, 1, 2, 3, 4, 5 were higher, 6 were lower. Consumer discretionary at the top of the pack, up 1%. Bottom of the pack, those utilities names, Tim, just down about 1%. But we did see a little bit of movement on the Fed news, just a hair.
Just a hair, and it also seems like investors were more optimistic in the sense of getting this stimulus package. That seems to be what is moving the market more so than anything we heard from Jay Powell.
All right, and let's see what Sarah Ponczek has to say about that. She is our Bloomberg News cross-asset reporter. Sarah, come on in. An interesting day. It was a Fed day. What's your takeaway? Because, Fed Chief Jay Powell did talk about asset prices.
He did talk about asset prices, and that's really what caught my attention. When it comes down to what the Fed did, the Fed pretty much did what they were expected to do. They left the composition and the size of their quantitative easing program unchanged. At the same time, we now see that 5 members of the Fed do predict a Fed hike in 2023. So still very, very far away. 5 members, that's up from 4 at the prior meeting, but still that's very far away, not the majority of members. And Powell, when asked about asset prices, commented on the stock market, and he essentially said that the PE ratio, if you just look at price relative to earnings, it's not very relevant anymore because in this day and age, with bond yields so extraordinarily low, you really have to put it in comparison by looking at bond yields as well. And this is actually a model that's come to be known as the Fed model. You look at the price earnings ratio, you flip it, so it's called earnings yield. So you have, instead of P over E, you have E over P, then you subtract out that bond yield. Well, right now we still have a spread of 2.5% in favor of equities. You compare that to the dot-com bubble, even though you look at plain valuations, you might say that now as then it looks a little bit similar. We're getting to those very high, very expensive levels. Well, back then, bonds yielded more than the earnings yield for the S&P 500. So it's a far cry from where we stood then if you do take bond yields into account.
One thing that was surprising is that we got revisions to the Fed's economic projections. It now calls for a smaller contraction in GDP this year and a lower unemployment rate. How does that sort of play with the economic pain that we saw in November and what we're seeing this month so far?
Right. Well, we're looking back when it comes to what the Fed said. And yes, we are getting to a point, and Chairman Powell also commented on this, that as we do see rising COVID cases, it's very possible that we do see a slowdown in the momentum that we had seen in the economy leading up until this point. We saw that this morning with the retail sales print as well. We saw a downside print, a downside surprise. We also saw downside revisions to the prior month, to the month of October. So we're already seeing this leveling off, if not sputtering, of momentum in the economy as COVID cases rise and more restrictions come to the fore too. But when we look at the Fed's predictions going forward, as you mentioned, now expecting a smaller decline in GDP, also expecting a lower unemployment rate. When you see that they are expecting a better economic print or their forecasts for the economy are just stronger, we can leave it there. However, at the same time, they are making it abundantly clear that they are on hold for a long period of time.
Right.
That's where the argument lies, where it's good for risk assets.
Yeah, and I thought it was also interesting, as you were pointing out, this could be another long expansion based on trends. I mean, I do wonder, Sarah, just quickly, got 10 seconds here, that we could be setting up for what we saw after the financial crisis.
Right, and it's unbelievable, though, because asset prices are obviously so much higher than where they were then, and we're beginning from record high levels.
That's a really important point. All right, Sarah, thank you so much. Bloomberg News cross-asset reporter Sarah Ponzak, and you are listening to Bloomberg.
All right, Dave, you're up.
Hi, my name is Dave.
Wilson, where are you? Wilson!
Just what do you think you're doing, Dave?
We're going for the price on Wilson.
Open up the door, it's Dave! Who? Dave!
Hey, Mr. Wilson. It's good. Hey, what are you taking a look at? Talk to us about your stock of the day here.
Spiro Therapeutics, Tim. It's a developer of drugs to combat infections. The company expects to file next year for U.S. approval of its first product, which targets urinary tract infections. Spiro is based in Cambridge, Massachusetts. The company was founded in 2013 and went public in 2017. The ticker is SPRO. Spiro made its initial public offering at $14 a share, and the stock's generally traded for less than the IPO price. It fell to a record low of $5.25 in March. Now, since then, Spiro has more than tripled. Today, the shares rose to a record after Berenberg began coverage with a buy rating. Data compiled by Bloomberg shows the firm joined 6 others in telling clients to buy, and there haven't been any hold or sell ratings on the stock since September. On top of that, Spiro was named to the NASDAQ Biotechnology Index effective Monday. Funds that track the index will have to buy the stock, and an iShares fund with more than $10 billion in assets is among them. You put that all together, Spiro's share up as much as 11.5% in today's trading. Though they gave back some of that gain, they closed higher by 5.5%.
All right, good name. Spiro Therapeutics, ticker is SPRO. Dave Wilson, thank you so much with his stock of the day. Dave, thank you. Really appreciate it. All right, just wrapping up this day, at least for you. I know, because you start early over on Bloomberg Quick Take, but, I do wonder, are you guys going to continue talking Fed tomorrow, or you kind of move on from it?
I think we will, especially, Carol, you talked about the idea of the Fed chair talking about climate change today, and it comes after yesterday's news that the Fed is essentially joining this consortium. And Fed Chair Jerome Powell punted a little bit and talked about how it's a non-political entity, which, of course, we know that is the mandate that Congress has given him. But it does say something when the central bank starts to talk about climate change, and the Fed chair does too.
Right, exactly. And listen, they have to look at the risks to the financial community and the financial sector, and so that is potentially a risk, and so that's why it's under his mandate. So looking forward to hearing more from the Fed on that. Thank you so much. It was your first Fed Wednesday with us.
My first Fed Wednesday and my first day broadcasting from my bedroom in Brooklyn.
You
and
did well.
So far, so good.
You did well, my friend. All right, have a good evening. We'll see you tomorrow. Tim Stanovic on Bloomberg Quick Take. Catch him at 9 a.m. tomorrow morning on Quick Take. All right, let's get a check on world and national news. For that, it's over to Ed Baxter in San Francisco. Hey, Ed, no snow there, huh?
Hey, yeah, and our weather's a little bit better than yours is going to be. There are warnings going out, heavy snowstorm warnings out for the northeastern seaboard in New York. Emergency Management Commissioner Deanne Criswell says the window of opportunity to safely move around or get out is closing.
The majority, the heavy part of this snow is expected now to start closer to 6 p.m. and go all the way through midnight.
So less than 2 hours. Says if people need to get out, now's the time. New Jersey Governor Phil Murphy saying basically the same thing.
These winds may lead to blowing snow in the northern part of the state and driving rain and sleet elsewhere, hampering visibility and making travel that much more dangerous.
And both talk of blizzard-like conditions. In California, new COVID-19 cases shattered any old records. Over 53,000 new cases, more than 18,000 any previous day. Hospitalizations jumping 4.3%. Operation Warp Speed CEO General Gus Perna says the rollout is going smoothly.
The volume was 145 on Monday, 425 yesterday, and 66 today. Right, so that was our get out of the gate, get going, really see ourselves, learn a lot.
Now, one burp reported some of the vaccine arrived stored at too cold of a temperature was sent back to Pfizer. About 1,000 doses are headed to California that were in that batch. And President Donald Trump has sat out the vaccine rollout so far. In San Francisco, I'm Ed Baxter. This is Bloomberg.
All right, Ed Baxter, thank you so much. I'm Carol Masser. Joining me right now is Bloomberg's Charlie Pellet. And boy, Charlie, I wonder if this is going to become a trend. Citigroup offering its workers a 12-week sabbatical, extra vacation days, massages, pedicures. No, I just added in the last two things. But they are offering up a sabbatical.
Yeah, you know, and I got thinking in terms of trends. 2 days in a row now, you and I have used the word sabbatical in one of our little chit-chats. And that's a word that we've never used together on the air. But yes, Citigroup offering all sorts of benefits. You've got your idea of a sabbatical. I've got mine, and that is studying sand formations on beaches, pina colada consumption on cruise ships, or perhaps if alcoholic beverages make comedians funnier. So that's what I'd like to explore on a 12-week sabbatical.
I would definitely do something like that in a 12-week sabbatical. You know, I know Chipotle years ago, they used to, I think after you worked at the company for a certain amount of time, you were given something like 3 months off, or I might be getting the duration, but you could basically just go off. It was paid and do whatever you want after you had been at the company for a long time. So anyway, staffers also at Citigroup, they're going to be able to buy as many as 5 extra vacation days 5 extra vacation days annually starting next year. The bank is debuting a program that also will allow employees to work pro bono with a charitable organization for as much as 4 weeks while still receiving 100% of their base pay.
Just let me throw this out there. I like the idea of the pro bono work, and that's a wonderful use of sabbatical. But I once saw a sign in a diner, and it said there are 24 hours in a day. 8 hours you work for the diner, 8 hours you've got to yourself, and 8 hours you sleep. And, you know, I'm just wondering,
what?
Am I old school in terms of the work ethic here?
What do you mean, working too much?
No, not working. You know, you don't go to work to get a 12-week sabbatical.
Yeah, I know what you're saying. I don't know. Listen, I think what's happening right now is companies are rethinking their relationship with their workers, looking at how working from home, whoever thought it would work as well as it has, and I think most would say it has, largely for those who can work at home.
Don't get me started. It isn't working from home, but that's another topic for another time.
That it doesn't work for you. It kind of works for me. I'm just saying I can be flexible. I like being at the office too, though. I'm just going to say. All right, Charlie Pellet, thank you so much. This is...
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet, just getting the latest quarterly numbers out of Herman Miller. Second quarter adjusted EPS, 89 cents. Estimates there were for 54 cents. Herman Miller, of course, the furniture maker for offices, says it will not provide quarterly sales and earnings guidance. Update on Wall Street, NASDAQ at a record, S&P very close. Stocks advanced on speculation that lawmakers are getting closer to a stimulus deal aimed at reviving the world's largest economy. Treasuries fell as the Fed disappointed some traders who expected changes to the composition of bond purchases. 10-year down 4/32, 10-year yield 0.92%. S&P up 6 to 3701, up by just about 0.2%. Record, by the way, 3702. The Dow down 44, down 0.1%. NASDAQ up 63 again. Record there up 0.5%. So far this year, NASDAQ up 41.1%. Gold up 0.5%, 1862 the ounce. Crude up 0.4%, 47.83 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, got it, Charlie. Thank you so much. This is one of the stories. Stop whatever you're doing because you're going to want to hear all of it. I love it. It's about how in this world of COVID and perhaps more virus and germs to come, if you want to make a building healthier, stop sanitizing everything. Let's find out more from Projects and Investigations reporter Carolina Winter with us on the phone in Berlin, along with Bloomberg Business Week editor Joel Weber on the Access line in Brooklyn, which I think, Joel, especially coming after a year where everybody was like sanitizing everything.
Yeah, I love this story, and it's been one that I was just really looking forward to publishing, in part because, as you know, Carol, we had a great Lysol story a couple weeks ago, and it was, the theme of that story was like sanitize everything, put Lysol over everything. It's so effective at killing COVID, and this is like the counterpoint, I think, which is, look, like when we do sanitize things, we annihilate everything, and yeah, sure, that gets rid of COVID. But how much do we really understand about the really small stuff? And that's where Caroline's reporting comes in, because there's actually this little mini movement that says we're actually doing a lot of harm, and I think this makes it really. It's especially relevant right now in New York as a snowstorm starts coming down.
Right.
That we're all going to be trapped indoors for the next couple months, and it's all about indoor environments. So Caroline, take us into the world of science and what we don't know about what's going on inside of buildings right now.
Yeah, sure. Well, so we're actually trapped inside a lot of the time. Statistics show that in the West, humans spend 90% indoors. Americans spend 93% about that inside buildings and cars. And there's a lot of research showing that our disconnect from the outdoor world is linked to a huge range of really serious chronic diseases. And of course, now we know that SARS also spreads much more easily indoors. And so a lot of experts are asking, how do you make the indoors healthier? And the understandable tactic has been to just whip out the bleach and just bleach bomb everything. Install air sanitizers, get your antimicrobial coatings. And the people I spoke with, they said, it makes a lot of sense just from we've long wanted to just annihilate all pathogens. But this may have really serious consequences for our long-term health, and may also not be helping very much against SARS, by the way.
Yeah. Well, Caroline, I think what's kind of interesting, too, is this whole idea of these indoor microbes. I just find it fascinating. And you talk about the microbiome of the built environment. And I love this. I wrote on the story when I was taking notes, EW, which encompasses trillions of microbes, including bacteria, fungi, and viruses. I mean, there's so much stuff in these closed spaces that we live in and consider a haven, a safe haven, and they're not necessarily.
Yeah, no, it's true. There are trillions and trillions of these. There's studies showing that there are actually an equal concentration of viruses as bacteria in indoor air. And what we have to realize is that there's no way we'll ever get rid of all of this stuff. So no matter how clean you make it, I mean, the International Space Station is filled with microbes, even though they disinfect everything that goes inside of it. And so what we're doing potentially by cleaning like crazy is wiping out some of the good bacteria that we actually really need to be healthy, and perhaps even creating more space for pathogens, including antibiotic-resistant bacteria, potentially, which would be a disaster.
Let's actually dwell on that for a second, because there is actually this ongoing study that you reference I think the thrust of it is like, what if the idea is like there's actually benign bacteria that could be all over everything, and that actually helps keep the bad stuff at bay just by taking up space. Can you talk more about that research?
Yeah. This is a really amazingly interesting scientist, Jack Gilbert, and he's doing a study right now in an undisclosed hospital in California. And the idea is really that if you sanitize everything and wipe off the microbes, and then somebody comes in and coughs, there's plenty of space. There's nothing there, so the virus or whatever germs they have can potentially take up root there and thrive. But he hypothesizes that if you take harmless bacteria and colonize that same surface, then the person who comes in and coughs on the surface, there's not as much chance for it to take up residence, because it will be outcompeted for resources by the stuff that's already there. And so the result, there've been previous studies to that extent with really encouraging findings, and this one is a little bit more in depth, but it's actually not that far-fetched. There are already all sorts of cleaners that people are using that apply this probiotic concept. There's spraying bacteria, and the bacteria goes in and munches away dirt and stuff like that in the cracks and crevices where you potentially couldn't even get to with cleaners. And so it's kind of a new frontier and an exciting one.
Okay, so put a bow on it. We only got a couple seconds left. Like, what's the one thing that I should be doing as somebody who's going to be trapped inside for months now? What should we be doing, Caroline?
Just got about 25 seconds.
Well, you just try and think about aligning your buildings with nature as much as you can. Open the windows when you can, even if it's cold outside. Try and get the air flowing, get as much sunshine in, and you should also just get outside more. I mean, that's actually the main thing, is that we need to all just spend much more time outdoors. That's the best.
Hallelujah. Like, we're going to just start doing this broadcast outside. I'm just telling you, taking it outside like we used to do in college. Caroline, thank you so much. Projects and Investigations reporter at Bloomberg Business Week. I'm going to put that out on Twitter, and of course, Joel Weber. For those of you listening in New York and San Francisco, watching on YouTube, we're going to continue. If you're listening on Bloomberg 99.1 in DC, Sound On is up next.
Broadcasting live to New York, Bloomberg 1130. To Washington, D.C., Bloomberg 99.1. To Boston, Bloomberg 106.1. To San Francisco, Bloomberg 960. To the country, Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
Yeah, you are listening to Bloomberg Business Week on this Wednesday. I'm Carol Masser, and you are listening to Bloomberg Radio. Coming up, we're going to check in on one of our most read stories on the Bloomberg today. It's a really fun one. It's about a well-known asset manager, but it's also got a holiday twist to it. So we'll get to that in just a moment. Let's get back to your top business stories. Once again, here is Charlie Pellet.
All right, thank you very much. Here's what's going on. Carol Master still awaiting the latest numbers out of homebuilder Lennar. We will have those as they cross the Bloomberg Professional Service. A record for NASDAQ. Oh, so close for the S&P. A down day for the Dow today. Stocks did rise on speculation that lawmakers are getting closer to a stimulus deal aimed at reviving the U.S. economy. Treasuries fell as the Fed disappointed some traders who expected changes to the composition of bond purchases. 10-year down 3/32, 10-year yield 0.91%. S&P up 6 to 37.01, a gain of about 0.2%. NASDAQ up 63, a gain of 0.5%. The Dow down 44, a drop of 0.1%. Gold up 0.5%, 1863 the ounce, up $9.93 today. West Texas Intermediate crude up 0.4%, higher by 21 cents a barrel to $47.83. You heard him live here on Bloomberg Radio, also on Bloomberg Television. Fed Chair Jay Powell touching on a number of other topics in his statement today, including COVID and the economic recovery.
The ongoing surge in new COVID-19 cases, both here in the United States and abroad, is particularly concerning, and the next few months are likely to be very challenging. All of us have a role to play in our nation's response to the pandemic. Following the advice of public health professionals to keep appropriate social distances and to wear masks in public will help get the economy back to full strength.
The S&P 500 index did notch back-to-back gains after Senate Majority Leader Mitch McConnell said congressional leaders are still talking about fresh aid, and he said he thinks, quote, we're going to get there. Stay with Bloomberg for the very latest out of Washington. Boeing is scrapping most pay raises next year and giving out shares instead as the company braces for a long recovery from the coronavirus pandemic. Today, shares of the playmaker fell by 1.6%. Recapping, S&P up 6, up 0.2%, NASDAQ at a record. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. You're listening to Bloomberg Business Week. I'm Carol Masser, and this is among our most read stories on the Bloomberg for all of today. It's about the world's largest alternative asset manager and what's becoming its infamous annual holiday videos, of which apparently Bloomberg got a copy of before it was posted online. So watching it and reviewing it for us, as only she can, is our Amanda Gordon, Bloomberg News Wealth Team reporter. She's on the phone in Riverdale, New York. Amanda, great to be talking with you. Missed seeing you in our studio. So tell us about, first of all, who we're talking about.
So Blackstone has a reputation for being a serious place where you work hard, and it has investments in the life sciences and real estate. It started as a private equity firm from Steve Schwarzman, who, by the way, does know how to throw a good holiday party, I think. But in this case, during the pandemic, they adapted to develop a firm culture that included Blackstone TV and weekly photo contests as a way of taking those 3,000 or so employees and bringing the firm culture that allows them to work so hard all the time to the virtual world that they were put in. And this, it's funny because these videos that they've been doing have been a way of sort of sending up that firm culture, and this year was just ripe with many opportunities to do that.
All right, and I'm going to just give our folks who are obviously listening on Bloomberg, but also maybe watching on our YouTube channel, they're going to get to see little clips or some of the video that Blackstone sent out. So give us some of what is on that video for those who are listening on radio.
Well, I thought it was fun that for those who were in the office, like the chief legal officer who's in charge of compliance, he's wearing a mask that says no. And we see that two of the senior executives one in real estate and one who's in charge of tactical opportunities, they've apparently let their hair grow out because their barber is stuck in Milan and they won't let anyone else cut their hair. And I mentioned Steve Schwartzman. He has a cardboard cutout of himself that he puts in front of the screen for those very long Zoom meetings. So, everyone's, finding ways to get around what's been a tough year. But, one of the fun parts is that John Gray, who's the president, is sort of the thread that holds it all together. And, in person, he's just, one of the nicest, earnest guys that you see. That's how he comes off. But here in these videos for 3 years now, he's been able to sort of, put himself out there to be made fun of. And so he's in effect the star of the show.
Well, I love that you say where I guess he's a terrible Secret Santa and he's got the crazy Christmas sweater, but he leads the meetings with no one bothering to tell him he's on mute. I think we've all been there where it's like either you don't realize you're on mute after talking for a long time or you've got a manager and you kind of sometimes just kind of wait a little bit.
I think that, in a way that some of the things in the video are things that that anyone can laugh at, absolutely, that are not firm specific. And, one of the reasons why they first canceled the party is that they didn't have a space big enough in New York, they said, to bring everyone together. And now that they and I am looking forward to, getting back to work and getting back to normal and what that will mean in our new world.
Yeah.
I think that everyone will want a really big Christmas party. And so for next year, they better add that to, at the end of the video and find a venue big enough to do it. So
right. And I will say fun and games, they certainly did in trying to bring some fun to their team. But let's not forget that they're not tone deaf. They've given millions of dollars donations for COVID relief in New York. They did, I guess there's a lip sync video that they did for first responders. So they've certainly been out there front and center, Amanda. Just got about 30 seconds left here.
Well, they also doubled the number of employees who are volunteering this season. So, I think one of the genius things about this is that they did it in-house, the whole effort.
It's amazing.
And that's, it's so easy to send a gift basket from another company or to outsource things.
Right.
And this is homegrown.
Yeah, and who knew that Blackstone had a mascot? And if you want to find out a little bit more about that, you're going to have to go read Amanda's story online or on the Bloomberg. Amanda Gordon, you're the best. Amanda Gordon, she's reporter at Bloomberg News Wealth Team, joining us on the phone from Riverdale, New York. Right now, we do need to get a check on world and national news. For that, it's over to Ed Baxter in San Francisco. Hi, Ed.
Hi, Carol. President Donald Trump's spy chief is considering holding up a report to Congress on foreign affairs, arguing it does not focus on China's effort to affect the U.S. election. Yeah, he's not given up yet. He has intelligence figures inside the Trump administration divided. This apparently another part of Donald Trump's flailing away at the validity of the election, and while also banging on China. Meanwhile, President-elect Joe Biden publicly introducing Pete Buttigieg as transportation nominee.
He's going to help build back better with jobs and hope, with vision and execution. And I'm honored he's answering the call to serve his country once again.
Biden, by the way, says he will take the vaccine as soon as it is available to him. Speaking of the virus, California shattered any and all one-day case records, over 53,000, more than 18,000 any other day. Hospitalizations jumping 4.3%. Frontline workers are getting the Pfizer vaccine, the first small startup. Nursing homes starting to see some encouraging words from Dr. Monsef Slaoui at Operation Warp Speed.
Onset of efficacy is very fast after immunization, and we should start to see an impact in the very high-risk populations that are being immunized as we speak.
And more from Moderna, he says, next week, assuming formal approval this week.
20 million doses will be delivered by the end of the month, and I think that's really excellent.
Well, the Northeast has started to get the first wave of what the forecast says is a major snow event later today.
We are expecting heavy snowfall, possible sleet conditions with high winds throughout the overnight. The roadways will be treacherous.
New York Sanitation Commissioner Edward Grayson, they're saying the window of heavy starts at 6. In San Francisco, I'm Ed Baxter. This is Bloomberg.
All right, Ed Baxter, thank you so much. And I'm going to say, just looking at my window, it's pretty light, a little bit of snow sticking on the cars, but as Ed just said, maybe it's going to start in about an hour and a half from now. All right, Carol Masser, along with Charlie Pellet, once again, of Bloomberg News. And listen, Charlie, no surprise that we're seeing everybody make adjustments. Just like the Fed said, they continuously and will constantly monitor kind of what's going on in the economy to adjust their policy appropriately. I feel like companies, everybody is adjusting according to the latest virus news that's out there.
Indeed, the goalposts keep moving, and specifically Wells Fargo now saying that it is extending work from home until at least March 1st. There was a guest that you had on Bloomberg Business Week a couple of months ago, and it was a great quote. The guest said, and I don't remember who it is, so I'm sorry, but the quote was something to the effect of, we all knew when we had to leave the office. We didn't know when we had to return the office. Do you remember who that was?
Yeah, I don't remember who it is, but you're right. You're right. Like, I think, and I think it's safe to say that all of us, when we started working from home, I think we thought it would be a few weeks. You know, we didn't even think it could be a month. I don't know.
Correct. I totally agree. I thought 3 weeks tops we'll all be back in the office.
Yeah. And so, listen, we have to adjust. We see the virus numbers. I mentioned the California number. I know you've been following it, Charlie, too. You know, just shattering records. Over 53, almost 54,000 reporting of new virus cases in California alone. The numbers are off the charts. And so that is why everybody has been predicting, anticipating kind of a long, dark winter. And it's upon us.
Exactly. Can I just say, though, too, 30 minutes ago, I was talking about how much I dislike working from home. And I really think that I represent a lot of people. You come into the office, you got better chairs, you got better lighting, you got fewer distractions. Yeah, you got some annoying coworkers, but you don't have cats walking all over you or you know, children who, you know, need your attention. And then the other thing, career-wise, chance encounters, you can accomplish more in 30 seconds. Can you? And the answer is yes, instead of scheduling emails or Zoom calls.
Charlie, the CEOs of corporate America, thank you very much for that. Charlie Pellet, of course. You are listening to Bloomberg Business Week. I'm Carol Masser, and you are listening to Bloomberg Radio.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Turned out to be a mixed Fed Wednesday. The Dow lower, S&P higher, NASDAQ at a record. Stocks gained on speculation. Lawmakers are getting closer to a stimulus deal aimed at reviving the U.S. economy. Treasuries fell as the Fed disappointed some traders who expected changes to the composition of bond purchases. The 10-year down 3/32, 10-year yield 0.91%. S&P up 6, a gain of about 0.2%. NASDAQ up 63, again a record there, up 0.5. The Dow fell 44 points, down by about 0.1%. 10-year down 3/32, 10-year yield 0.91%. Gold up 0.6%, 18.64 the ounce. West Texas Intermediate crude up 0.5%, 47.86 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You're listening to Bloomberg Business Week on Bloomberg Radio. Well, the pandemic, as we know, has been especially hard on arts organizations as performance venues around the globe have really been shuttered. Bloomberg's Janet Wu takes a look at how 2 symphonies are finding their way back, bringing new concerts and music to an even bigger audience. Check this out.
The orchestra is an art form with no personal space. Musicians perform shoulder to shoulder to synchronize as one. When the pandemic struck, the Boston Symphony Orchestra immediately canceled its season. BSO General Manager Mark Volpe.
Orchestras across the country have obviously lost their ability to have in-person audiences, and we have, candidly, in Boston, maybe the largest audience along with Los Angeles. So in the course of a year, we've lost about $50 million in ticket sales and other earned income.
Along with the financial losses, some of the world's best musicians were left unheard. How can an orchestra perform with no room for social distancing? You make room. Here at Symphony Hall, they more than doubled the size of the stage.
We've taken a 2,400 square foot stage and made it close to a 6,000 square foot stage. And all the string players are 6 feet apart. All the aerosol producing instruments, like the brass instruments and winds, are at least 10 feet apart. Some are 12 feet apart. We put the percussion players up in the balcony, the harp players over in the balcony over there. She feels that she's been upgraded, sort of like on an airplane.
There's still no live audience, but the musicians are thrilled to be back together, even if together has new meaning.
The brass section's basically in a different zip code than the strings, but somehow we've learned our physics. Sound and light travel at different speeds, so everyone's had to make the appropriate adjustments, and then we're making music again.
All this is possible because 120 years ago, BSO founder Henry Higginson had the uncanny foresight to build a concert hall with removable seats. The seats are taken out for Pop's dinner concerts and even for an elite squash tournament.
But no one ever dreamed these century-old seats would help the BSO face the pandemic.
And one of the great ironies is we're reaching more people than we've ever reached.
Nearly 20 million unique viewers since performances went online.
Even though the business model doesn't work, we're touching more lives with music than we ever have before. 6 continents, 88 countries. And so we're able to fulfill our mission.
The Dallas Symphony Orchestra also got creative.
We did, believe it or not, 90 concerts outside, chamber musicians all around Dallas, on streets, driveways, cul-de-sacs, parks, you name it. Our musicians just brought out their stands and played for 30 to 40 minutes to whoever was willing to just come on out and listen.
And indoor concerts with just 42 musicians. General Manager Kim Noltemy says the audience is capped at 150 in a hall built for 1,800.
Every single person who's coming is so enthusiastic. For weeks, you'd look out and people would be crying during the concerts. They were so moved to be able to watch. And in fact, after the applause, people would shout thank you from the audience to the orchestra as they were getting off the stage, which was just so poignant.
The orchestras are recording new concerts with multiple high-definition cameras. The silver lining is that someone with tickets all the way up here can now get this close to musicians.
You get angles, you get perspectives that you can't have in a normal concert. I mean, the one thing I have to say is you cannot replicate having, an in-person audience that all are sharing the same music at the same time, shoulder to shoulder, and we all relish the moment where that can happen again. But until then, we are creating content that is being seen by millions of people throughout the world.
Facing incredible challenges, the BSO and DSO are determined to come back, knowing music is more important than ever.
And joining us now from Boston is Bloomberg's own Janet Wu, who just did that report. Talk to us more about what the BSO and DSO are doing to keep the music coming. I gotta say, Janet, first of all, great to be talking with you. I can't believe we haven't talked in a long time.
I know. We are usually together around music, so it's a little bit bittersweet.
It is. I totally agree with you. And I think what's interesting is what they said, towards the end. It's not the same as being in person, but I gotta say, it's pretty remarkable what the BSO and DSO have figured out how to do in this environment and bring music to people.
Yeah, so Carol, definitely they are facing the biggest challenges because when you think about arts organizations, you can have a one-person play or a one-woman show. You cannot have a one-person orchestra. So they were stuck in the dark for a long time before they figured out what they could do. Now, in Dallas, they have the benefit of weather. They're not getting a nor'easter like we are right now in New York and Boston and generally the Northeast. So they went outside. They went to cul-de-sacs. They went to driveways. They went to parks in smaller numbers. In Boston, they had that quirky little benefit of the founder over 100 years ago saying, I'm going to build this hall where we could take out the seats. Little did we know how this would benefit the orchestra in a pandemic.
It's pretty remarkable. You and I have also been there in the concert hall when the seats have been removed and listened, to the BSO and it's pretty, and the Boston Pops specifically, and have seen how that works. It is pretty remarkable, but you think about the financial impact that these organizations are taking, because as many will say, and we've heard this from the restaurant community, we've heard it from Charlotte St. Martin of the Broadway League, with Broadway shut down, you need a full house or close to it for it to be all financially viable.
And usually, Carol, it only barely makes it because when you think about a symphony, it's a very expensive organization to run. You have literally hundreds of musicians. You have that many people supporting them. You have the people taking care of the music and the rights and so many different things and taking care of the hall. And of course, all the programming that changes. Every week, you have people that are also escorting people and ushering there. So it really supports a lot of people, a big organization. And again, it sometimes barely breaks even when you do have those full houses. And it was very, very sad to see this. And also, adding to this, they also lost touring revenue because the Boston Symphony Orchestra was supposed to go to Korea right when the pandemic struck. They were also planning a larger tour through Europe. So this has been very stressful for them.
You do wonder, no doubt about it, incredibly stressful. And I do wonder, though, what out of this, certainly they'll get back to performing live in front of large groups of people, get back to touring, but I do wonder that whole idea of being able to touch more people globally, if that becomes something that stays with them and they figure out how to kind of work that in as well.
So here's the new normal and the silver lining, two words that we maybe overuse, but let me explain them in this context. I spoke with both the general manager of the BSO and also the conductor of the Pops, who we know, Keith Lockhart, and they say that a digital component will be part of every season moving forward because that's how they actually maintain people that want to be in their audience.
Yeah, I really love that. That's the good side of what comes out of disruption and crisis, but we know it's just been a tough time for all cultural and arts organizations. Janet, great report. Janet Wu, of course, of Bloomberg, and you can catch her certainly out of our Boston team. And don't miss a Holly Jolly celebration with the Dallas Symphony Orchestra in partnership with Bloomberg. That is this Friday at 7 p.m. Wall Street time on Bloomberg Television. You are listening to Bloomberg Business Week. I'm Carol Masser, and this is Bloomberg Radio. Our latest on the virus coming right up.